Full screen? Yeah, there we go. All right. Hopefully this is good. You sound all right. Thank you, Carbonomics. Today we're going to be going over trash YouTuber stocks because I uploaded a quick video about it yesterday. And actually the comments were overwhelmingly positive, and I realized actually there's a huge niche to be filled here. A lot of people just literally don't know how to look at the financials of stocks. Now for me, I will say I was inspired quite a bit by Strongman Personal Finance, and also recently I went back to school and I'm doing an accounting program, obviously post-bachelor's, and I'm starting to learn some things and I feel like I can contribute here meaningfully. Let me get my chat back up. Because, oh man, is there a lot of garbage out there. It's pretty bad. It's pretty bad. We got a really funny lineup here today. Well, Carbonomics, you're going to be a target of this too, because one thing I don't like is how many people, it seems like people in Europe find out or fall for this, but man, people love buying garbage mining stocks. Garbage. You see them all over Twitter. Here's how the mining scam works. First, they flood the investing space with news. Such and such mineral material is at critical levels low. There's going to be a shortage if new supplies aren't found by blah, blah, blah. You can search that article for literally everything. Copper, rare earths, helium, right? You can search it. Every single one of those has industry articles. Oh, such and such is facing a critical shortage. That applies to all of them equally. Also uranium too. I've seen that about that as well. And then they have people in the lottery mindset where they think, this area has been proven to have a huge amount of blah, blah, blah. If it's discovered and developed, it'll be game-changing. Game-changing. And I should have known it. Like, I don't want to disrespect anybody, but when I was looking at people who were talking about stocks like that on Twitter, every single one of their pictures was them at like a baseball game or a football game or a soccer game or something like that. I was just being honest. I thought, these people don't really look like they're sophisticated investors. Not that I do either, but... yeah, that was one of the many bad signs. They're all trash. They're all scams. Total waste of time. In fact, there was a guy in my Telegram journal who said he was mostly in gold mining and silver mining stocks. Ugh, I feel bad for him. But anyway, we've got a really funny lineup here set up today. So let me introduce these videos. First is Jeremy Financial Education. This is a brand new video 3 days ago. Top 5 risky stocks I own. You shouldn't own any risky stocks. By the way, I haven't watched any of these videos. This is going to be all live reacts. This is going to be hilarious. The next up is Stock Mode Best Penny Stocks to Buy Now. Growth Stocks 2023 September. And then finally, so this is a newer channel. I haven't heard of him. He must be newer on the block. His name is Kenan Grace. I'm going to keep an open mind about him. I saw him mentioned on Strongman Personal Finance's channel. I don't know anything about him. It's possible he talks about decent stocks. In fact, most of his videos are just about general market trends, which, obviously it's not exactly the best content. It's not really too edifying, but it's not the worst thing ever. It's not like totally menacing and hurting people. So I don't know. Maybe this video is fine. Maybe he's, has a cautious approach, but definitely I'm not going to be pulling my punches with these two. It should be very exciting. All right, let me just, oh, I wasn't even sharing my screen. You guys couldn't even see as I was clicking around. Figures. Let me show you again. So, Jeremy Financial Education, top 5 stocks I own. Stock Mode, Best Penny Stocks to Buy Now. Growth Stocks 2023 September. And then finally, you've probably never heard of this AI stock. Last one I'll keep an open mind with. Alright, so let's see.
5 riskiest stocks I personally hold. That's what we're about to get into here today, folks. Okay, I'm about to run you through my 5 riskiest stocks, why these are my riskiest stocks. I thought this would be a very valuable video here today, running through the risk factors of these stocks. And, obviously, whenever you're going to buy a stock, like so many people get caught up into the reward potential, and that's great, right? But I thought this would be just a great reminder of the risk you take, obviously, when you go into making a position in a stock. And I thought...
So he's actually making a good point. Most of the time when people buy these trash, like microcap or super speculative stocks, they don't take anything into account other than, well, it could go to this, it could 10x, and then if I put $1,000, it means of $100,000, and that means I'm set, I'm on my path. I remember thinking the same thing back in university when I found one of these crappy trash biotech stocks. Everybody was saying, it's going to go from $1 to $100. And so I remember doing the math in my head, thinking, if I put $100, that's however much money, and then if I put $1, that's $100, and 1,000 to 100,000. It's just ridiculous. So he's right about that. Though coming from him, it's a little bit too late, right? He's known for how many stocks that have gone to literally zero. It's a talent to pick that many have gone to zero. So it's possible he's doing some self-reflection and learning, but probably not enough and probably too late just based on what he's going to be saying.
I would make this video and I might make another video later this week. Let me know if you guys would be interested in this video or not. But I was thinking about making another video, my top 5 least risky stocks.
Yeah, I don't know if I would really take his his opinion on risk factors too well, given his history. You know, it's kind of like when there are interviews with people all the time online. They're ex-cult members, right? And they try to give advice for falling for cults. At least for me, I don't think I've ever fallen for a cult. I don't think I am ever going to fall for a cult. So it's kind of counterintuitive, but the person who's the least likely to fall for a cult doesn't need the advice. And the person who's most likely to fall for the cult isn't really good to give advice because you already fell for it. So you're actually what you do is the perfect example of what not to do if you're going to fall for a cult. So Jeremy's kind of the same thing. He's like an ex-cult member who's trying to give advice on how to not fall for cults, even though most normal people don't. And that guy did.
Or my top 5 safest stocks that I personally hold. So if you're interested in me making a video like that later this week, let me know in the comment section. I can certainly make one of those.
Skip
I
this.
thought that might be
Blah, blah, blah.
you know, before we get into all 5 of these stocks and what makes them so risky and those sorts of things, right? And by the way, I got a free new workshop for you guys. It's going to be pinned comment down there. Make sure you access that when today's video is over. It's 5-part. It's absolutely free to access that. I think
advertisements, advertisements. CreatorHeadStart.com if you want to find out how to succeed on YouTube, make money without showing your face. There's my advertisement.
P. Morgan, you're still taking it.
CreatorHeadStart.com, and after the stream, I'm going to be launching a service to pay for dedicated sponsored video topics. More on that later.
Risk. I personally own JP Morgan stock, by the way. Stock 1,000. There's a reason, dog in my but and so when you're a great example, a lot of you could go bank. You know,
I lost
I
my
didn't lose
spot
100% in that stock, but I lost.
Yeah, I was saying that in my video today. I was killing myself. I was punching myself. Why didn't I say FTX? I said Kamikoto Knives, and I said established titles, but how could I forget the king of all scam YouTuber sponsorships, FTX? If they can't even figure out their own sponsorships, why would you trust their stock picks? Unbelievable. Let me see what he actually talks about this stuff.
Ceilings that makes the 85-inch TV look like it's a little Cracker Jack box.
I have no idea what he's talking about.
A TV over there, people always dogging my TV. That's 85 inches. You don't want a 20-foot ceiling? That's what it looks like, okay, folks? That's what an 85-inch TV. It looks like a little.
Yeah, I'm not gonna criticize how to decorate a house. If you saw mine, I have no clue what I'm doing. I'm literally that meme where they say guys only need this, and it's disgusting. It's like one little chair in front of a TV in an empty room. I'm literally that meme. I have no clue how to decorate.
iPad up there. That's just the way it is, okay? But Tesla definitely changed my life. Like, you know, I still probably wish I did hold all the shares I used to hold, but I held so many shares. Like, people have no clue how much money that stock really made me, right?
No, people do have a clue, and it's the one thing that made you. It was a combination of getting lucky, and I know for a fact it's lucky because like literally everything else you've talked about has been above average total failure. And also too, there was a lot of YouTube interest around it, and you had a lot of YouTube advertising about it. I get it. I know what that's like. I would say probably 80% of my net worth is responsible from the fact that I have 500 million views on YouTube. I totally get it.
Beauty, another great example. I used to hold like 10,000 shares of Elf Beauty, right? This one certainly.
Oh, so I guess he's starting off the stream. This is the angle. He's starting off the stream talking about his biggest wins to soften the blow of how many garbage stocks he's in. Well, look, I succeeded 2 times, ignoring like the 100 other times it failed. Yeah, it's funny. They call it survivorship bias. Usually that's just an implicit bias. He's actually doubling down and trying to engineer survivorship bias by buying a bunch of trash and then 2 work out. And this is, look, I did it, see?
Was a game changer for me. Not as much of a life changer as Tesla.
Man, he loves to talk.
The chef is a great example of, well, you know, I didn't lose 100% in that stock, but I lost pretty dang close. It was 90-something%, right?
How do you hold a stock all the way down from 99% down or 90% down?
It was a absolutely brutal brutal loss. And so when you're finding companies, right? And remember, when I was buying Tesla back in the day, it was a very risky stock. You know, it had a pretty bad balance sheet. For my standards, it had a bad balance sheet. There was a lot of people thought they could go bankrupt. There was a lot of thought.
This is all hindsight bias. If you actually look at Tesla's balance sheets compared to the other stocks these YouTubers recommend, it wasn't that bad. Like, sure, it wasn't as great as something like Apple or something like that, but it really wasn't that bad. I think I've done a comparison video before between that and Fisker. Or maybe it was Lucid. Yeah, it's for memberships on this channel. I did a comparison between Lucid and Tesla looked like, again, like a blue chip S&P 500 like company in 2019 in comparison to something like Lucid. So that's actually not even true if you look at Tesla stats.
That Elon Musk wouldn't be able to pull it off, and I accept it's economical. What had lead to a pretty bad. Who is my fifth riskiest? Okay.
All right, so it looks like here we are 4 minutes and 17 seconds in. This is like anti-YouTube advice. You're supposed to get to the point these days within 30 seconds or less. I'm not perfect at it. I mean, sometimes I take a minute to get to the point. Just got a text message. But anyway, here we are, 4 minutes, 17 seconds. Finally at the first one.
My top 5 riskiest stocks I personally hold. My fifth riskiest stock I hold is Fubo. Fubo is my fifth riskiest stock. Obviously, it's had a
just listen to this. This is my top 5 fifth riskiest stock is Fubo. Fubo is my fifth riskiest stock. Man, it's like ChatGPT.
Tremendous past 6 months. Stock's up 133% in the past 6 months. It's doing amazing right here recently. It's
okay, so Fubo. So he says it's doing amazing. Let's check up on it. Let's see. Then afterwards we'll listen to his what he thinks about it. Yeah, Jeremy does know how to pad time. Okay. This is so funny. Where is he getting that it's up 100%? What did he say? All I'm seeing is it's down 70%, and all it's ever done is lost money for its investors. What did he say?
Seems like it's turned the corner. Riskiest stock. All right, so let's talk about my top 5 riskiest stocks I personally hold. My fifth riskiest stock I hold is Fubo. Fubo is my fifth riskiest stock. Obviously, it's had a tremendous past 6 months. Stock's up 133% in the past
6 months? 133%? Oh, so I guess like, yeah, literally from this bottom, going from $1 to $2. Yeah, so this is just a little, like, this is a little insignificant bump in like the total annihilation downtrend in this company. I wonder if he buys it in multiple accounts to make it seem like, look, I made 130%, even though this thing's a massive loser trash. Yeah, this is one of those classic things you see. The revenue's growing, but the losses grow with it. So, I haven't looked under the hood yet, but if I had to guess, it's because they just don't know how to operate their company and they bleed cash faster than they bring it in. But let's see. So anyway, already we're off to a bad start. I think it's just, to be honest, it's an automatic disqualifier. If you see a chart like this where it starts off and then just immediately like negative 45 degrees angles down, if a company is, if all they've ever done is lost money for their investors, what makes you think you're ever going to be more special? Like, this is only just 2 years ago. Yeah, it lost already like 99% just 2 years ago. Amazing. All right, so we got TTM up. Yeah, they do a good job growing their revenue, except not really, apparently. What's with that? Oh, that's the revenue growth, not the actual revenue. Yeah, they do a good job growing their revenue, sometimes up to 5,000% in a year, 200%, 50%. I will say the revenue growth is slowing down, though obviously we don't have a ton of information to go off of. It's slowing down, which is not a good sign for like these smaller, like NASDAQ growth companies. And let's see, the cost of the revenue. Oh, thankfully too, the cost of the revenue is scaling with it. It's not growing as fast, but let's look at the cost of revenue. I mean, I haven't even looked at the gross margin yet, but I can tell this company is like a non-starter. Even before all the operating expenses, right? The cost of the revenue is pretty much the same as the revenue. Like, you can't operate a company like that. This would have to massively go down, and it's not. I don't see a dramatic decrease, and it seems to correlate every single year with the revenue itself. And let's see. Well, this isn't as bad as I thought it would be. So at least their selling, general, and admin is only like a fifth of their revenue. I've seen a lot worse, and I think we will see a lot worse. They're keeping the research and development low. That's usually rare. Usually on these trash companies, they have massive research and development. Other operating expenses might be useful to look into, but oh, look at this. Growing, or okay, so the operating income loss is decreasing. That's a good sign. It's not the total end of the world. It's essentially no gross margin. Well, we haven't gotten there yet. We'll see. They're keeping their interest expenses down. That's good. That means they're probably not tacking on huge amounts of debts, but that usually means the alternative is that they're just diluting their shareholders into oblivion, which, frankly, the chart seems to suggest. Usually you see a chart like this where their shareholders get annihilated is because they're diluting. Because even like on a bad company, this isn't the worst I've ever seen. On a company growing revenues like this, and it looks like they're keeping their losses more or less stable, even though it increased dramatically 2021 to 2022, you still shouldn't necessarily see this total annihilation chart, which probably, if I had to guess, signals dilution, but we're not there yet. Net income, yeah, on the bottom of their income statement here, the net income, they're not doing a good job bringing the losses down. Yeah, these losses are in line with the past 3 years, if not the past 4 years. Not doing well for them there. Let's see, net income to common. Yeah, the same thing. They're not improving this. Oh, here it is. I called it. Shares change. 100%, 400%, 100%, 200%. Oh, it was only 30% last year. This thing's improving. It's going to be saved any day now. Oh, man. Let's see this. Yeah, so 44 million shares 2020. I can still remember 2020. It wasn't that long ago. To, let's see, today. Almost 300 million shares. You got wiped out. You got destroyed. You know, again, if there were people just 2 years ago in the stock just like you, and they get wiped out like 70%, 80%, 90%, what makes you think it's going to be any better for you? Obviously, I haven't looked at the business itself or anything, but this is horrible. This is diluting garbage. You're just, even if nothing changes in the company, you're just going to get wiped out. Unfortunately, Jeremy was one of the first YouTubers I stumbled across when I thought about dabbing into stocks. Oh, I'm sorry. Boy, that was a mistake. Luckily, it didn't take long to realize he hasn't the faintest. I think you mean the faintest idea. I'm sorry about that. Oh, I feel bad for you. Thankfully, well, not thankfully. I stumbled into YouTube finance really early, like before these YouTubers even existed. There was almost no content at all, which made me think it wasn't worth making a channel about it because nobody on YouTube was interested. You have to remember, YouTube used to be like TikTok, and everybody on there was like below the age of 25, so they just had no interest in stocks at all. But yeah, what a bad introduction. Though, that said, there actually aren't really that many good introductions on YouTube finance, period. Probably the least objectionable, I know everybody says this is Graham Stephan, but there are landmines you're waiting to step on everywhere, whether it's, you know, Jeremy Financial Education, Meet Kevin, Stockmo, and there's a million others I can think of. All there are landmines, and I hate to say it, but the channels that actually preach responsible investing, they don't communicate the message well. They try to talk about the benefits of buying individual stock or the buying ETFs over individual stocks, but they have it like in a very dry, academic, almost condescending way. I think actually the best way to educate people on how to invest like a responsible person is to attack the garbage. I think like once you see how bad the garbage actually is, you'll realize, oh, okay, I'm not a genius. I'm not going to get rich just for existing just because I'm a 25-year-old guy. I actually need to work hard, double down and actually invest responsibly and not like an idiot. That's a very hard message to convey to, a 20-something-year-old guy who thinks that they're going to be rich because I've got potential, I've got hustle. And they're not going to listen to somebody like the Plain Bagel talking about, over the course of 30 years in this peer-reviewed study, we found that ETF investors outperform blah, blah, blah by 20%. Nobody's going to listen to that. And so the trash is more exciting. It's got stories, it's got narratives. And so I think the only way to get through to people who are making the mistakes like Hasina Farms, thankfully, who got out of it, but the only way to reach people like that is to attack the garbage. That's my opinion. Carbonomics, your stuff is not coming up. Let's see. You say here, responsible investing isn't interesting, especially at looking at filings. People get bored with that. Yeah, but one thing that's not boring, I agree with you, by the way, but one thing that's not boring is looking at how awful these companies are. Nobody gets it because all they do is focus on the narrative, right? So like, we'll listen to what Jeremy's narrative is later with this FUBU thing, but if I had to guess, he's going to make it sound exciting. He does a good job of making stocks exciting, I will tell you that, but you got to just ignore these narratives and look at the real information here. All right, so once again, yeah, they're not really fixing their net income. They're diluting their company into oblivion. Okay, the operating margins are getting, well, it's hard to see, negative 50% to 25%. That is improving. All right, so here we go. I talked about this in my video. Oh, they actually managed to get a slightly positive 2% gross margin. I think that's the lowest positive gross margin I've seen this month. So again, I'll explain this for people who didn't see the video. A gross margin is just like the basic cycle or like the basic system for your product. It doesn't include the management on top of it. It doesn't include taxes. It doesn't include marketing or anything to run the company. It just means, is your basic product profitable? So let's take, for example, iPhone, for example, Apple. All it does is take the revenue you get from the iPhone product minus or including the cost of goods sold. And cost of goods sold literally means that. How much does it cost to sell your goods? And so usually it includes things, maybe it even explains it here. Cost of revenue, yeah. It says cost of goods sold, it's related to the company's production of products and services. So just what it costs. I'll get to Burry's epic short later. I'm kind of soured on him, to be honest. And so, like, if your basic product only barely ekes out like a 2% margin, most of the time negative, I'm sorry, you shouldn't be in business. Like, that's a kid's lemonade stand level of a gross margin. Like, they're just out there for fun. They don't really understand the prices. They just want to be in the act of business, right? So if your gross margin is barely positive, stop the presses. Game over. It's finished. You have no chance at all. Like, just compare that to a company. I did this in the same video, but I'm sure many of you missed it. Apple. Their gross margin is 43%. They're making 43% on their products. This thing, after all this effort, is doing 2%. People don't understand. Buying stocks is not... It's about the price and whether the price will go up, but there's also more to it. You want to make sure you're buying an engine, and you want to make sure that engine is actually generating revenue for you, not losing it. And that's just the gross margin. That's the bare minimum standard. Looking at the operating margin, it's negative 25%, though they are, on the bright side, it is going down. That's good. It was negative 51%. 2 years ago, it's negative 25% now. These are improving, but a lot of these companies are able to improve because when you're at the bottom, when you're at the bottom of the trash can, the only way you have to go is up. And so people will say things like, look, these margins are improving at this rate, by X date, it'll do blah, blah, blah. The reality is, if when you're starting your business and your margins are already this bad, it just means you're not good. Again, it's easy to improve when your margins are negative 1,000% or negative 200%. It's a lot easier to improve that than Apple going from 40 to 45%. You know, ideally, you shouldn't even be on the stock market if you can't get your gross margins to work, or at least on top of that, the operating margin. And again, I'll explain what an operating margin is. All it means is including your cost of goods sold and actually what it takes to operate your business. Are you making a profit, right? Because obviously you have to pay for executives, marketing, research, that sort of thing. So everything listed here are all the operating expenses. So here they have selling, general, and administration expenses and research and development expenses. We talked about that a little bit later. They do a pretty good job of keeping their selling, general, and admin in line. It looks like the executives aren't like looting the company, which is good. And 1/5 of revenue, I've seen worse, I've seen better. But the problem is, again, their cost of revenue is so ridiculously, unbelievably high that even just the basic operations behind their business, just having people in offices, having people doing marketing, sinks them. It totally sinks them. It's getting better, but the only way to improve this is if they cut their R&D, which they're not, or cutting their selling and general and admission expenses, and that's not happening. And as they grow their revenue, they're not bringing down the cost of their revenue. So really, the only way to save this company is if they bring down the cost of their revenue. And I'd have to calculate the ratio between revenue to cost, but I don't see that happening. I just don't. It hasn't happened yet. Except for, it looks like TTM. So this year it looks like they might finally have a positive gross profit, though they did in 2019 too. Okay, so now let's look at the balance sheet. One thing I want to find out is the shareholders' equity. Okay, so it is positive. I talked about this in my video. If you have a negative shareholders' equity, that literally means there's more debt than assets. So when you buy that stock, it's like you're buying a house where the mortgage is $500,000, but the house is only worth $250,000, right? You're underwater on your mortgage. So if you're shopping around, like with your, wife or fiance, and you want to, get a house to live in, start a family in, and the real estate agent goes to you with, look, you want to buy this house? The mortgage you have to assume control over is $500,000. It's only worth $250,000. So you'll have to owe $250,000 when you buy the house. No, of course not. Nobody wants to buy that. And so this is the most basic thing. Don't buy stocks that are underwater on their mortgage. And the way to find that out is looking at the shareholders' equity. But unfortunately, this is declining. So that's probably a product of taking on debt and also diluting their shareholders. I don't like to look at the balance sheet too much because, at least on this website, you should look at it on the actual SEC filings. But just for the sake of this stream, I will. Looking at the total debt, Okay, so they paid it down 1 year in 2020. That's good, but actually, I'm surprised. I thought they were mainly paying for this through dilution, but it doesn't seem to be. Okay, so yeah, it looks like they took on a ton of debt in 2021. It's $446 million, and they're keeping it about flat this year. They're not taking on debt. Let me see how much they increased their stocks last year. Their shares, I should say. Oh, yeah, so they halted the debt growth and they decided to dilute. That's what they did. Okay. Cash and equivalents, 220 million, about 48 million receivables, 397 current assets. Current liabilities, okay, they're underwater. They're about matched their current assets to current liabilities. Okay, not underwater, not as bad as I thought it would be. Long-term debt, 434, long-term assets, 843. Okay, so their debt situation isn't terrible, probably as they diluted. And how much did they raise? This is gonna take a long time. I gotta go through these stocks faster. Shares change. Actually, we can see that through the financing cash flow. Okay, that's actually going down. That's good. Less of the money is coming through the company through financing cash flow. Dividend payment, share issues, and repurchases. Okay. Yeah, so it looks like that's going down. That's good. Investing cash flow. Oh, interesting. Buying and selling investments in long-term assets. They must have sold something. They must have sold one of their acquisitions. Interesting. Yeah, they haven't done any acquisitions in a while. Okay, so this company is not as bad as the ones I looked at yesterday. I still wouldn't buy it, just based on the fact that, let's see their operating cash flow. Ah, that's it. Okay, so this company is bleeding just by running the engine of their business. I found it. This company is bleeding $300 million, $250 million a year just by existing. And this is not going to stop unless they lower the cost of their, the cost of their revenue, and it's not. So every time you throw $1 into this, it's throwing it into an engine that just bleeds out money, and it has to come in through some way. So it looks like they're making up for it through, let's see, financing, which means, yeah, issuing shares and taking on debt, which they had to do dramatically in 2021. $500 million in sheer dilution in debt. Yeah, so it looks like they're paying for this mainly through selling acquisitions and also selling and debt, selling shares and taking on debt. So I don't see the point of buying a company that doesn't even have positive operating cash flows. This is just garbage. Don't know what to say. Let's see how he justifies it, though.
6 months. It's doing amazing right here recently. It seems like it's turned a corner, but...
It seems like it's turned a corner. What corner? Seems like maybe is this tiny little dip up here, is that turning a corner? Come on.
Still comes with a lot of risk, okay? Here's the deal. Fubo obviously pitches it as, hey, we're making great progress toward our 2025 profitability goals.
I don't see it.
They raised their forecast. As of last quarter, they reduced their net loss by $41 million. Record ARPU in North America. That's
achieved a 7% gross margin. The company I called total trash yesterday had a 13% gross margin. If it takes you 5 years and losing billions of dollars to get to 7%, it's not a good company. It's not like it's the dating market, right? There are plenty of options on the stock market. You don't have to be in something like this.
Great. They're making a lot of progress, but at the end of the day, here's the numbers, okay? Their net loss from continuing operations last quarter was $54 million. Now, they should likely get that under control more and more over the future quarters, but it's not guaranteed. It's still a 54...
2025 probability ain't happening with those margins, but it could if they just literally cut all of their... Yeah, it's ridiculous. It's like this guy's saying, they've improved it to 7%. No, you can't run a company off a 7% gross margin. I think it might even be mathematically impossible.
Net loss from continuing operations, right? Adjusted EBITDA was negative $30 million, and free cash flow was negative.
Does he even know what EBITDA is? He's circling these terms, and it's just random. It's interesting to compare my analysis on the stock versus his. You notice I saw that they're bleeding out cash, and you have to figure out, okay, why is this happening? And you want to get to the bottom of this, right? You're doing an investigation. I took a long time, but I think I found out the root cause of the problem in the first 3 minutes of talking about it. It's the cost of their revenue. They're just not bringing it down. And I notice here in his analysis, it's just completely absent. He's circling, okay, free cash flow, EBITDA, net loss from continuing operations. Yeah, there's a net loss, but you have to figure out why that's happening, and he's not saying why that is. So I don't think he knows how to look at stocks at all. Again, when you see a net loss, that's the conclusion, but you want to find out why that's happening, and he hasn't done that.
Negative $75 million.
Easy. Maybe he meant turning the corner to the bad part of town. Yeah, like when you follow your GPS and it takes you straight into the bad part of town. Yeah, exactly.
In this latest quarter, okay?
How can you make a whole presentation on this company and completely miss the fact? This is unbelievable. How do you make a presentation and you only focus on this little dip up here when we're talking about a negative 70% loss, and then on top of that, you don't see that the cost of their revenue, right here, the cost of their revenue has been the same as their revenue in total for the past 4 years. How do you miss that? Okay, well, EBITDA, net income loss. How do you miss that? It's basic. It's not like they're even doing fraud or anything. It's just basically right there on the basic financials. I don't know how you missed that.
So the bottom line is, Fubo's got a lot of work still to do. Have they made a lot of progress? Absolutely. Do they?
Okay, I went through this before. Yes, they have a lot of work to do, like not having a 7% gross margin. And like looking at this rate of progress, it's only a few percent a year on the gross margin. The operating margin should really be reaching, after 5 years in business, you should be starting to, dip your head above the water there. This is not fast enough. And if you're bleeding out $300 million a year, or however much it takes in your cash flows, it's just not going to happen. Again, you can credit companies like this for making progress because it's easy to make progress when you're literally losing every single dollar you make. The only way to go is up. Unbelievable.
Still have a lot of progress to make? Absolutely, okay? Because the bottom line is, look at this, okay? So as of the end of last quarter, they had around $300 million in cash equivalents, and restricted cash, okay?
Yeah, but at the rate they're burning it, that'll be gone in a year. You need to look at these things.
Which is a pretty good sum of money.
Yeah, his analysis is he just copy-pastes the shareholders' letters. And in the shareholders' letters, they're focusing on like the few metrics that have any indication of going positive, and he's missing the big picture. Yeah, I mean, I see here he's just falling for the shareholder letter propaganda here. I don't see, other than the gross margin, which is kind of like a roundabout way of referring to it, I don't see anything here about lowering their cost of revenue.
But it's not if you're losing these sorts of dollar amounts, right? And so at the end of the day, it's very important Fubo continues to cut down on these losses massively. We need to see in 2024 small losses. I mean, very small losses. We need to see...
Just buy stocks that go from big losses to small losses. Well, there's no guarantee that's going to happen. I don't see anything in the record that indicates they can even get there.
Quarters.
Because, like, I'm sorry, the buck stops here. If your revenue literally goes straight into paying to get that revenue, it's over. You've lost. Like, so for example, my YouTube channels, I could pay for YouTube ads and I could increase my revenue by just running ads, even though I'm losing money in every single ad. Let's say I pay $1 for 1,000 views, but those 1,000 views are only making me 20 cents. I could keep spending and spending and my revenue would go up, but then my cost of revenue would scale with that and I'd never get profitable. It's a very easy concept to understand.
Where they only lose $10 million.
Any YouTuber could do this. Just run ads to get yourself more views and more AdSense revenue and say, look, my revenue's growing.
On the bottom line.
By the way, this is what dropship scammers do. They run a whole bunch of ads to make their gross revenue go up and say, look, I grossed $1 million last year, ignoring that they spent like 1.5 times that on ads to get people to go through their system.
$20 million, $15 million. We need to see those type of quarters. If we're seeing those type of quarters in 2024, I can tell you then, we're looking really freaking good with this one.
Okay, then why not just buy then? Part of stocks is risk reward, right? If you're waiting for 2024, 2025 for maybe an indication that the numbers are continuing to go up, then fine, buy then. There's no reason to buy now. There's so many other opportunities out there than doing this coin flip stock that hasn't figured out how to get their basic gross margins under control over the past 5 years. There's so many different opportunities out there.
In 2025, we can start talking about flipping, the ultimate flipping to profitability, right? And so that'd be a great scenario, but at the end of the day, it's still very risky because, man, the company's still losing a whole lot of money. Now, how do they get there?
Yeah, so why would you buy something that's losing money? The point of buying a share, taking over something, is you want to get an engine and you want to get a machine that generates you money, not loses you money. Now, obviously, this is where they get people. They say, well, it has the potential someday to break even or someday to maybe generate a little bit of money. then you need to go into actually making a financial model and comparing, like, is it worth it buying at this price now for maybe the potential at different rates it could generate this much money per share, this much money per share, and he doesn't do that. He just says, well, in the future it could go up.
Here's the deal, okay? Subscribers. They need to continue to attract a ton of subscribers. Based upon Google Trends.
Okay, this is flawed analysis. So he's looking at Google Trends, and he's saying, look, people are more interested in Fubo over time. Everybody in the world could watch Fubo. It looks like it's some, like, internet TV thing. Everybody in the world could watch Fubo, but if they spend all their money, all their revenue just getting customers or running their system, then it's not going to work. Again, if you spend $1 to make $1, you're not making any money at all. It doesn't matter if you make $1 million if you're spending it. $1 million to get that same amount. It's just not going to work.
Data, they are attracting ridiculous amounts of subscribers right now. Okay, we'll see what they put up for this quarter. They probably won't announce the numbers for this quarter until November, unless they pre-announce because something's so shocking in there. But as long as they don't pre-announce, we'll hear likely in November. My guess is we're going to hear some pretty insane subscriber numbers, and numbers much higher than even the company was anticipating.
It's true. They probably could have insane subscriber numbers because they're giving their service away for free. You know, a good way to look at this would be, if you actually were serious about looking at the stock, is not judging their success about how well they do when they're handing out their service for a loss. Like, they're literally paying their customers to watch their service indirectly. It's not literally, but like indirectly this is happening because they're losing money every single time somebody subscribes to it. So like a way of looking at it more directly would be, you know, they hand you a subscription and then $50 with it. That's the equivalent of what they're doing because they're paying to lose money on these subscribers. And we've seen from other streaming services, guess what? When they increase the price, when they lose ads, their stock goes down. They lose subscribers. That has a negative impact on it. So Fubo would experience the same thing. You can't just assume that, oh, they're going to grow subscribers because they're giving it away for free, that this is going to continue and then they'll be able to charge everybody on that. Some people there are only there for the free stuff. And Netflix had the same problem a year or two ago.
Okay. We need folks that sign up for Fubo to sign up for more expensive plans, and then we need the ads business to kick in a major way.
Okay, I think we've had enough on Fubo. I think we get the point that it's not a good stock. So let's see what he's into now.
In case the market tanks in any substantial way, of 3x of the Dow Jones Industrial Average.
Okay, so this one looks like it's a short ETF. I've talked about this. I wouldn't bother with something like that.
So if the Dow Jones Industrial Average goes up on Dow for the NASDAQ, and yes, they do. It's called SQQQ.
Did he watch my video? Like, how's he finding out about SQQ right now?
And this is for folks that like to basically do the inverse of the NASDAQ on a daily basis, which is certainly a dangerous rate. This baby started from...
Okay, yeah, I don't want to talk about his short ETFs. Oh, we're going to watch an ad together, everybody. Because I'm a cheapskate and I refuse to pay for YouTube Premium. Oh, but it's like Fubo, right? Someday I will pay for YouTube Premium, right? Unbelievable. All right, so Avant Brands. I haven't heard of this one. AVTBF. Okay, is this like OTC? Oh, it's OTC. I'm sorry, OTC is an automatic disqualifier. If you're bothering with something, if it doesn't even show up on my website because it's over-the-counter penny stock trash, I'm sorry, that's automatically a disqualification.
Certainly a risky stock.
Not bother with that, yeah. Okay. Penny stock is automatic disqualification. You're a loser if you buy them. So far we have garbage, 2 inverse ETFs, and a penny stock. What's this one? PLNHF. Looks like it's another penny stock. I'll try that one too. Is that Planet 13? Is that what he's in? Oh, okay, it does show up on this one. Okay. Finally, we got one of his penny stocks to show up on here. All right, so let's see what he says.
Certainly a risky stock, another $100 stock. So yeah, it's going to be risky for these sorts of companies, right? Now, this just goes to show you kind of the risk of a company like this, right? Check this out. So I'm looking over their latest investor presentation, and, you know, it's a simple typo, but it's, you know, embarrassing. It's embarrassing. So
he's investing in a company that just typos. Typos on their filings and investor relations content. Oh, man. That's embarrassing. They have a typo. Yeah, don't invest in it. Don't invest in it if they can't even fix a typo. Oh. All right. Okay. Well, typo or not, let's see what this is about. Okay. So this company, all it has ever done is lost money for its investors. All right. Great job. So we're talking 4 years, 5 years. Let's just compare that to the S&P 500. 5 years. It's given you 54%. This company has given you 40%. Looks like, but you'd have had to hold it through all this drama. Let's see. Yeah, okay. -60 to -90. Interesting. So, let's look at declining revenues. Usually with these channels, they try to talk about companies that at a minimum have increasing revenues because like there's some potential there. There's a source of hype, right? This one's declining in its revenues. Interesting choice there. Let's see. Okay, so their cost of revenue is only half of their revenue, which is better than Fubo. That's good. It's only half, okay. But revenue is declining. It's been declining the past 2 or 3 years. That's really a great sign. You love to buy companies where their revenues are declining. They make typos. Selling and marketing, that's 4% about of their... Oh my goodness. Yeah, okay, this is one of those companies that just loots. They just loot their shareholders. Look, so the cost of their revenue is more than half of their gross revenue. And their general administrative is also half of their gross revenue. So if I had to guess, you just had a bunch of employees and marketing executives and executives generally just sitting on top of it, skimming money from this. Like, it's already game over. If your cost of revenue is half of your revenue, and just to run your business, like literally just to have your office guys as the other half, it's over. It's finished. It's not going anywhere. Because these things never really come down. And it's maintained the same ratio forever. Actually, I wonder in comparison for Apple... What's the ratio for them to actually run their business here? Okay, so their cost of revenue looks like it's less than half. That's good. And their selling in general and admin is also less than half. And this is for App. Oh, that's not Apple. I'm sorry. That's App 11. My apologies. I was wondering why it was so bad. Okay, so their cost of revenue here looks like, yeah, that's about half. They're selling. Oh, but look at their selling general and admin. 25. Hang on. Let me go full screen here. Let me bring up my calculator. Let's see how Apple actually isn't looting their company as compared to this one. So 25,000 divided by 394,000. Yeah, they have 6%. 6% for Apple, 50% for this one. This is garbage. Trying to learn how to invest. What books do you guys recommend to somebody who's starting with zero investing / financial knowledge? I don't have books to recommend. If I had to guess, I would I could recommend to you YouTube channels. I'll type them in the chat for you. There's obviously mine, but there's also Strongman Personal Finance. Plain Bagel is okay. Beyond those, there's nobody else I really feel... Did I misspell bagel? I think it's like that. Anyway, other than those two, those are the only ones I feel comfortable talking about. Everyone else is just doing clown stuff, garbage stuff like this. Okay, so we're back to Planet 13 here. Yeah, so they're looting their company, spending half of their money just running their office, and Apple only spends 6% on that, so it's game over already. You're welcome, Riley. Let's see. Operating. Okay, they have positive operating income. I am shocked. How do they manage that? What on earth? Oh, because they do have gross profits. Interesting. Okay. That's interesting. Okay, so they were negative and borderline negative. They managed to go to profitability, barely. $13 million operating income. Interest looks low. Looks like they're not doing terribly with debt. Oh, but this is where it happens. Pre-tax. Okay, other expense / income. So also they have a massive charge right here, more than their cost of their revenue. This will have to get solved. If it's some kind of debt, they'll have to look into it. But yeah, if they have a massive like interest expense or income expense, that usually means they'll have to dilute to pay for it, which means shareholders get wiped out. So let's see what this is. Other expense or income is any non-operating item that does not fall under another non-operating category. It often includes non-recurring items that are not a part of normal operations. Okay, so there's a chance that this is temporary. Oh wow, they were only mildly unprofitable, and now they're incurring this massive charge here the last 2 years, and it's just absolutely annihilating their net income. But you'd have to look into that and dig into the SEC filings. You wouldn't be able to figure it out what's happening with that on a website like this one. Ooh, nice dilution, about 10 to 20 to 30% a year, 40% even. Nice. Let's see their shares. Okay, so they actually seem responsible. They managed to repurchase shares 2017 to 2018. But ever since then, they've been diluting and diluting and diluting. Yeah, so if you're in a company that's diluting massively rather than repurchasing shares, you're also fighting an uphill battle. The gross margin's good, actually. That's a good sign. What does Planet 13 even do? Let's say cannabis, of course. Of course, yeah, because the narrative is got to be exciting and fun. Cannabis, it's the future. It's always got to be some exciting story, right? Well, anyway, their gross margin's pretty good. I've seen worse cannabis companies. Operating margin, it's okay. Again, there are better companies out there. Like, compare that to Apple. Let's say I'm on the income statement. Yeah, Apple 43%, 30%, 25%. This is 43, 13, negative 50. So I'd have to look into this, but they'd have to get this this other expense income solved. But it's not the worst company I've seen. This is definitely better than Fubo, that's for sure. But let's see their balance sheet right here. Shareholders' equity is positive but declining. Okay, at least see they're not buying a house underwater. That's good. Yeah, when I say things like that's good, don't be deceived by it. When you're looking at trash stocks, your standards are very low. Frankly, all these stats are totally unacceptable for any decent stock. But just like compared to the absolute worst I've seen, at least it's not a total outright negative. Always keep that in mind when I say something like, when I say that's good. All right, so massively negative net income all the time. They are barely keeping their operating cash flows above the waterline. They're like this, always on the verge of drowning, going massively negative. So yeah, their operating machine, their business just bleeds out cash. Not much, thankfully, but it still bleeds it out. And it looks like they pay for it through financing, so debt and issuing shares. Interesting. They're letting just cash bleed out of the business. They have been like the past 4 years. So that means that if this continues, eventually they will have to figure out a way to bring in more money in the company, which means dilution. But for now, they're just letting it bleed out about, $12 million a year. So yeah, if they got 40 million on hand, okay, they probably feel like they can let cash bleed out because they have cash on hand to pay for it. But eventually they will have to solve this. Eventually they will have to fix their operating engine because it just bleeds out cash. Not as bad as the other ones I've seen, but not terrible either. Or it is terrible, but not as bad as the worst I've ever seen.
They basically have their second quarter, and it's supposed to be comparing 2022 versus 2023. And instead they put second quarter 23 to second quarter 23, which is not accurate, right? And so that's just one of those frustrating things you got to deal with these sorts of companies. Like, Apple's not making a typo like that.
Yeah, you're right. It is a frustrating thing to deal with these companies. They're on the OTC, meaning they don't have oversight. They're not as regulated as much as companies on the NASDAQ or the New York Stock Exchange. So now, you know what you do? Is you don't buy penny stocks. That's what you do. You don't buy penny stocks if you want to have access to basic financial information correctly. Don't buy penny stocks if you don't like that.
You know, like
most people don't.
Meta's not making a typo like that. The Planet, I guess they will. Okay, somebody must have been enjoying the product too much when they went to put this presentation together. Holy smokes, okay? Now, also their cash as of the end of last year, right? Which this kind of bugs me why they put the cash at the end of the year, whether or not the latest quarter, like that doesn't make any sense. But anyways, they had about $40 million there, or maybe they just didn't change these numbers as well, which is certainly a possibility. We'll see maybe in the next slide. But they had $40 million. I can guarantee you that number is likely lower now based upon all the money they've spent recently, acquisition, just cost in general, net loss.
Acquisition, just cost in general. Does he know what he's talking about? Let's actually verify that. You can't just list things off the top of your head. So, cost of revenue, it's about $50 million, $60 million a year. Let's see if they've done any acquisitions. Okay, so he actually is telling the truth. Oh no, that's actually not true. So they sold one of their acquisitions in 2022, which gave them about $1.5 million. So they're not making acquisitions. It looks like they made one acquisition this year for about $900,000. So it's more or less balancing out here between selling and buying. Let's see if they're doing capital expenditures. These are also going down too. So they're decreasing their capital expenditures too. When you're decreasing a capital expenditure, all that means is in your company, actually I'll just read out the definition for you so I can be 100% accurate. Capital expenditures are also called payments for property, plants, and equipment. Yeah, so it just means like how much you're spending on your business, like long-term assets, right? So If your capital expenditures are going down, that can mean two things. Either you're doing a good job of making sure you spend your money effectively and more cheaply, or you're giving up. That's another example too. I'm not saying this is the case here, but I'll give you an example. Like on my YouTube channels, when I decide to wind one of them up, I'm not going to make videos on them anymore. My spending goes down. I let freelancers go. Less people edit for me. I spend less money on ads. I spend less money on like software services, subscriptions. I spend less of my time. So the comparison there would be my capital expenditures are going down. It can mean I'm being more efficient, I'm spending less money in my business, or it can mean I'm giving up and I'm winding the thing up. It depends on what it means. You have to look into other factors to determine what's going on.
Loss, things like that. Okay, so here's the actual numbers for the company. And as we see, this is the latest quarter for 23, and this was 2022. So this should have said 2022 over here, right? So here's the deal. Revenues went down in the latest quarter. Gross profit went down in the latest quarter, and net loss went up substantially for the company in the quarter.
Okay, if you say that revenues went down, net profit went down, losses went up, it's over. Buy something else.
Right? On a year-over-year basis. Now, I believe that is the trough for the company. I believe, basically the business just gets better from here. That's my personal belief based upon...
Based on what?
What I've kind of heard and seen from pricing side.
What I've heard and seen from pricing side, what does that mean? It's a pretty big claim to make that, hey, this company is massively losing money, but this is the bottom. It's going to come up from here. And then you say rumor? That's a pretty big claim to make, and there's no evidence to back it up.
The business side in general, I believe this business troughed, and I believe every quarter kind of moving forward here for quite a while is going to be better and better and better, and they're going to be able to, hopefully flip that bottom line back around.
Let's see, is there any evidence for that? No, and in fact, it's just been getting worse every single year since 2020. There's no indication of anything getting better in their cash flows. There's no indication that, let's see, compare that to revenue. Yeah, there's no indication that they're improving their cost of revenue. There's no indication, okay, they are cutting their admin expenses. So that's one thing that might indicate this might be the bottom of the trough. But other than that, is there any indication they're going to stop diluting shares? No, that's still going up. So you only have one factor out of the, numerous, many important ones that even indicates that there might be even a potential of being the bottom of the trough. There's just no evidence to support that whatsoever. I don't know why he's saying that.
And also start
He's a man of faith. Yeah, you have to be to buy penny stocks.
And these revenues go up and up again, which will be certainly very, very exciting. Now.
Yeah, because that's the most important thing in the stock market, right? Whether it's exciting or not. I'd rather make money. I'd rather make money in the most boring, dependable way possible. A lot of these people, I feel like they're too young and they're just like they're bored and need excitement. That's why they invest like lunatics on the stock market. Investing should be boring. It should be like going to the gym. You do it because you like the results of it, not because you enjoy the process. Even though I do enjoy the process, I'm one of those weirdos. But most people aren't like me.
To add more confusion to the planet overall and why it's unfortunately my second riskiest stock is. They just bought this VidCan company, right? Or Vita.
I don't agree with his rankings. I actually think this company is less risky than Fubo. Just based on the fact that they have better gross margins and other various statistics. And they do have positive news coming, right? So positive news coming is there might be legalization in the future. And if legalization does happen, they have not total bottom of the barrel trash margins to deal with it. But then at the same time, if it is legalized, I suspect their selling general and admin expenses will go up. It's not as bad as Fubo, right? So the streaming market is actually being crushed and annihilated right now. Netflix is having trouble. Disney Plus is having trouble. They're having strikes in the industry, trying to figure out who gets paid what. Streaming is a lot less wind behind their sails than marijuana does for sure. Oh, I just got demonetized. Anyway, yeah, this business and this industry has a lot more potential behind it. It's interesting that he ranks this as more risky than the other one. I just don't agree with that.
Can, and they spend $4 million of cash. They're going to dilute shareholder value in regards to this. And I don't
Oh, wow. Who called it?
know what this is going to make for the financials. I just don't.
How about this? How about you buy companies that have positive cash flow and you just wait to collect that cash flow as a shareholder and they buy back your shares so your shares go up in price? That's an easy way to make money. Just pay the money up front, buy a decent, engine, if you will, that actually generates money, buy that, and then just wait to collect the rewards from it. Why not just do that? And then if you're already thinking at that level, moving on from penny stocks to normal stocks, then why not just buy an ETF? It's basic. You know, the great way to make money is buy things that aren't underwater and losing money. That's a good way. Like, again, when people are doing real estate investing, even if they're flipping houses, they don't buy houses that are underwater on their mortgages by like 80 to 90% with like no expectation of that changing in the future. You pay a decent price for a decent thing that will give you a return. Simple. I know obviously there's like more into it than that, but that should be the basic premise and philosophy behind it.
I don't know. And so this is one of those deals I just kind of have to put my trust in management team, but I can't buy more shares of stock right now.
Put your trust in the management team that has typos and they're crucial. They're crucial investing relations material.
Absolutely not, because I don't know, this might be a brilliant acquisition, and this might look back in 3 years, 5 years and be like, geez, man, what a genius acquisition that was by the planet.
There's no indication that their acquisitions are brilliant, because the last one they just sold a year ago. They just dumped their acquisitions. I don't know what it is, so I can't comment, but this company's history indicates that they just dump acquisitions to pay for the fact that they're bleeding out money. Slowly, it's a little tiny hole in the hull, but they're still bleeding.
To make that deal happen. But I don't know as of right now, right? It's
all right, let's skip to the next one. He's just going to bloviate about it, like, well, I don't know my feelings. It's risky, but it's not risky, and it could turn around the corner. It's just going to be rambling. Believe me, I'm saving you time. All right, what's the number one? What's the riskiest stock?
It's shocking. This is my new...
How can anyone read this handwriting? Honest. HNST. Oh boy, oh boy.
Now 40.
I'm a little familiar with this company already. This is going to be exciting, trust me.
51%, like pathetic, okay? But here's the deal with this company. So they just brought in a new CFO. Now,
that's a good sign. They just brought in a new CFO. Why would you highlight that? That's one of the worst signs. I'd rather a CEO change than a CFO change. Oh boy, that's dangerous.
You might see this as, so Kelly Kennedy's stepping down from the company, right? Which, they kind of cleaned house there. They got rid of the CEO, obviously, at the end of last year and the beginning of this year. They brought in Carla Vernon, who...
That's not good.
Seems like maybe she'll have it going on, but we'll see, okay? I can't get too excited about any of these folks. But they kick out Kelly Kennedy. Well, she's stepping down. We'll call it that, okay? And they bring in this gentleman from Duluth Trading Company, right?
Duluth is okay.
And at first, I don't really follow
that
Duluth,
brand.
So I was like, okay, at least he has public company experience being a CFO, okay? And I looked at this company, I'm like, oh no.
Oh,
no.
I stand corrected, I'm sorry.
The stock's down over 80%. Are you flipping my flapjacks? They bring in this guy to be the CFO of the company? Oh my God.
I will say, because Jeremy's been criticized so much these past few years, he is a lot more aware of why he's failing. He's still missing key things, but he's a lot more aware of it. But he's not drawing the necessary conclusions from it.
Gosh. Oh my gosh. And of course you can't pin this all on the CFO of the company, right? It could be many other things, and just, it could be the CEO's fault, it could be the marketing team's fault, and many other folks. But at the end of the day...
Or how about it's all their fault and they're all bad, which is why they all left.
It's not great to see a CFO incoming to a company whose stock is down 80% in the past 5 years.
That's true, but also it's a bad sign, period, when the CFO, other than retiring, it's bad when the CFO changes.
It's like, are we kicking out somebody who wasn't doing a good job for a person who does just as bad of a job? Like, that's the way I kind of think about this. Like, when I first clicked on Duluth, I was like, oh, please tell me this is a company that's been executing well over the last few years. And I'm just like, oh my gosh. Oh.
Then sell.
It's honestly so frustrating. It's honestly so frustrating.
Sell.
Net loss for the company last quarter came in at $13 million.
Okay, he's going to go through the stats. So before he says that, let's see what we find. Honest. $1 stock, that's a good sign. Not very old. Oh yeah, it's only like a year old or so. And all it's ever done has lost money for its shareholders. If in the past all a company has ever done is lost money for people, what makes you think you're going to be better? What makes you think it's going to turn around just for little old you? All this has ever done is even down 11% just on the one day. But anyway, if it's all it's ever done is lost money, there's no indication that it's going to start making money just because you bought it. This is abysmal. Flat to declining revenues. Yeah, declining from last year. A chart, like, I'm sorry, if a chart looks like this, it should be an automatic disqualifier. You shouldn't bother. Which is funny because he was willing, when he looked at Duluth Trading, that was enough for it to be an automatic disqualifier. But when his stock has this chart, all of a sudden, well, it's possible that the new management team, it could improve. Take your conclusion from Duluth and applying to this one. They're probably remarkably similar if I had to guess. I'm glad you noticed the pattern, Hasina. All of his charts look like this. Even just in this video alone, every single one looks like this. And then what makes him think he has the right to like sneer at Duluth Trading for having this chart? Unbelievable. All of his charts do look like that. That's funny. Just got a text message, gotta check that. Anyway, so let's dive into these amazing financials. This negative 45-degree line red chart. If the chart looks like this, just don't. You don't even have to look. Just don't bother. Let's see. Revenue. 2020, 300 million. TTM 334, 313, 318. So declining the last 2 years. It looks like it is up. So they're just inching up. But let's see the cost of their revenue. Oh, it's interesting. Their revenue is like struggling to get into the air, but oh boy, the cost of their revenue has no trouble getting up in the air. You see that? Unbelievable. So looks like they've got 2/3 of their gross revenue just on the cost of revenue alone. They grow negative 2% to 6% a year. Not good. They still have a gross profit. Gross profit is declining. Great sign. Selling, general, and admin increasing, and also looks like it's more than, or it's about 1/3 of their gross revenue. Great sign. They're not really doing any R&D, which they probably don't have to because this is diapers, wipes, and personal care. Okay, maybe they should, but interesting. Yeah, this selling, general, and admin is abysmal. How do you spend $140 million just on like running your office versus your $330 million in revenue? Because obviously they're not doing R&D, or they're not doing other stuff. Only $6 million in R&D. So what are they doing in here, spending $140 million on this? Unbelievable. Yeah, company expenses not related to production. I think I found the problem. Yeah, so negative operating income, and the operating income is, it's going down. It might turn a corner, guys. This might be the bottom of the parabola. Oh, man. It's going down. This is the completely wrong sign. Probably because, yeah, they're selling, general, and admin's going up. These people are... It looks like, from a quick glance, that the insiders, the employees, the executives are just looting the company. Outstanding shares. Dilution. Going from 34 million to 91 million, you just got 2/3. You're 1/3 of what you used to be. Dilution. Great job. Free cash flow negative. Oh, so they have a decent gross margin. It's not amazing. Again, Apple's in the 40%. This is less than 30%. But negative operating and profit margins. Yeah, and look, surprise, surprise. The operating margin is getting worse every single year. Same with the profit margin. So it looks like they've got like clown management here. Garbage, idiot, moronic management. And until this gets solved, there's no indication it is. Until this gets solved, they're going to run negative margins on operating and profit margins and not make any money and lose money for their shareholders. And surprise, surprise, the stock price reflects that. Let's go to the balance sheet here. Shareholders' equity. Okay, so 2020, this house was underwater on its mortgage, but now it went positive, but it's going right back to where it was. It's been declining since 2021. They were 179 million in the clear, and they're down to 124 million. I wonder what's causing it to go down. I wonder what's causing it to trend towards being underwater on their mortgage again. Go to the cash flows. Pretty basic. Operating, they are bleeding out, but it's improving. Okay, so they're getting back in line in 2020, but they're negative every single year. So that means the engine of their business bleeds out money. Money has to come in through somewhere. So, surprise, surprise, it's through investing in financing cash flows. Not so much financing cash flows, investing. Let's see right here. They are... Looks like we can ignore that. It's almost nothing. Where are they getting investing cash flows from? Doesn't say right here. Interesting. So I'd have to dig deeper. I'd have to actually go on their filings, but it looks like they're getting it somehow through their investing cash flows. But net cash flow is obviously negative. So yeah, this is trash garbage stock. I'll look at their balance sheet right here. $18 million cash and cash equivalents. Current assets $144 million. Current liabilities $41. Total debt, long-term liabilities 26. Okay, so they're not massively in debt. Yeah, so it's funny. Like, they don't have an excuse. They're not massively in debt. they just suck at running the company. There's no other way of looking at it. Like, they've done a good job of like totally not like overloading themselves with debt, but they still just dilute their shareholders into oblivion, and they don't know how to run their offices without spending $140 million a year on $330 million in revenue. Trash.
That included $1 million in costs related to the transformation initiative, compared to a net loss of $10 million in the second quarter of 22. So basically, net loss went up for the company overall.
Up.
Balance sheet had about $18 million on it. So here's the deal, okay? Honest needs to honestly get their margins and bottom line fixed fast.
Which margins? Because that's actually not totally accurate. I will say their gross margins kind of sucks, but it's not terrible. It's not the end of the world. And these operating margins are only at negative 16%. They're closer to positive than those other companies you had on their list. You were showing way worse ones, like at the negative 40% level. So why is this particularly bad to you? I agree, though. Like, if they got the morons out of management here and stopped spending $140 million on all their stuff, maybe they could. But I just see no indication that's going to happen.
If they don't fix fast, they will be another chef. They will face another, let's call it the depths of a bankruptcy.
No, I don't think this is as bad as Tattoo Chef. Let's see. Tattoo Chef grew revenue faster. Their cost of revenue is the same as that other FUBU company he had. They spend more on getting their revenue than their revenue itself. Their selling general and admin is about the same ratio as Honest. A little bit higher, okay. Yeah, this one has a lower ratio of selling general and admin versus Tattooed Chef. Let's see their gross margins. Yeah, I mean, frankly, Honest has way better margins, so I don't know why he's saying that. They got a pretty positive gross margin. Their operating ones are 16 to 17%. Tattooed Chef was negative 60 on both of them throughout its existence. Negative 17, negative 14. So, yeah, I don't know why he's saying that.
Type situation, or they're going to have to try to dilute shareholder value, which is not going to...
When we try to dilute shareholder value, they already have massively, like the past 4 years. What do you mean try? I already demonstrated that.
Be pretty when your stock's $1, okay? They need to fix things quickly, so Carla needs to work quickly and get this business in a right place fast. And there's no reason why she shouldn't, considering the revenues this company has coming in and the relationships and the partners this company has. I mean, they're close with a lot of the biggest, most important retailers.
They're close to the biggest, most important retailers. This has potential. They're making connections, blah, blah, blah. The narrative's exciting. You hear this every single time with these like negative 45-degree red charts. Same thing every time. But the story's exciting. There's potential. Buy something that's profitable.
Retailers you could ever want to be close with. So Carla better get it done and get it done absolutely quick. But yeah, that's my number one riskiest stock in the stock market. Who would?
No, I don't think that was your riskiest one. Their debt didn't look, well, again, keeping in mind this is relative to Jeremy's most risky stocks. This is already as bad as it gets. They're not on the verge of being annihilated. Maybe they're on the verge of getting kicked off the NASDAQ, but other than that, yeah, I don't know. Maybe I'm just nitpicking too much.
Have known diapers and wipes could be such a risky business. I appreciate everybody joining me as always.
Who knew diapers and wipes could be such a risky business? It's not, actually. It's not. What's the name of that blue chip company that does all the diapers and wipes? What's it called? Is it Procter & Gamble? Consumer packaged goods, beauty, home care. Yeah, this is it. It's actually not. If you like this business, there's Procter & Gamble right here. And it doesn't have a negative 45-degree knife chart, assuming this loads. Oh, it's the opposite. Yeah, if you love this business, why not look at something like Procter & Gamble? Revenues are growing, and so are, like, well, the profits are kind of... But it's also a very mature and grown company. It returns value to its investors. It's got positive gross margins. Revenue grows. It's not a risky, difficult business. You need to not have morons in management. Yeah, this, like, look here. Their selling general and admin is a fourth. And the other one's like more than half. Found your problem.
Always thanks so much for being here, folks. Let me know if you want that top 5 safe.
Okay, so this is going to be just the outro. I think we'll go through this one, and then we might wrap up the stream after that. I'm going to take a brief break. Write your questions in the comments. I saw before one guy was talking about Michael Burry. I'll get to that. Thank you, EC. I was thinking of Johnson & Johnson. That's another example. Procter & Gamble's fine too, but Yeah, it's not an exciting, difficult business. It should be relatively low on drama. Oh man, I got white in there. The screen is making me bright. Anyway, rate your questions. Gonna take a brief break. Right here, yeah. Okay, thank you. Definitely needed that break. Definitely needed that for sure. Had to turn on my fan. It gets hot in my studio. Turn that off now. Any thoughts on AI and the market surrounding that, and LLMs and GPUs, etc.? So I use AI a lot on my YouTube channel portfolio, but I haven't looked at too many companies around that, and I don't have any thoughts about it. Sorry, but I'm not going to talk about something I don't understand. But I definitely appreciate that question. I don't know if you guys remember, but the last live stream I did was about a portfolio of ETFs and bonds I did. I had to put that on pause, and the reason was that First I thought I was going to retire from YouTube entirely, but my retirement failed. I got so bored, so I talked it over with my fiance, and we decided that I should go back to YouTube. But unfortunately, I used that money. I used it. I took it out of the account and I spent it, so it's down to 0. But when I start doing that again, I'll put it back in and I'll continue that series. Don't worry, it's always in the back of my mind. It's still the right strategy to do, but I put a pause on that series for now. So we're gonna focus on trashing YouTuber stocks instead. But sorry, no thoughts on AI. Oh, you found where I get my music. All right, so here we are on Stockmo. Lapsed boomer investing. Yeah, I'm a lapsed boomer. Yeah, it turns out when you want to have kids in a family, it's more expensive than you thought. So I had to get my grubby hands on that portfolio. Yeah, part of the problem was I locked up most of my net worth in this like really long-term investment. It's gonna take forever to get back, so we need to raise more money, unfortunately. So I had to get my grubby little hands on that investment, but I'll make up for it. I'll start doing paid videos later, and hopefully we can get that going. Thanks for saying it's fair, though. I appreciate it. I made that classic small YouTuber mistake of announcing series and not following through with them. That's a big, big, big mistake on YouTube. Anyway, here we are in stock mode, the best penny stocks to buy now. Let's check this out.
About some of the plays I've been putting out there, the TMFs, the TLTs, the Neos, the Tesla, the Nvidia. But how about some good old-fashioned best penny stocks to buy now? What kind of plays can we put $100 in there and walk out with 1,000 down the road?
It's true, that is the penny stock investing mindset. Put $100 and just get $1,000. Play roulette. Play roulette. It's fun. You meet people. You get drinks. It's exciting. Just play roulette. Don't do this loser penny stock stuff. Put $100 and get 1,000.
Or walk out with 0. Let's be honest. We're not. If you're here watching for the best penny stocks to buy now, I always know that you understand what this is about. This is about taking the highest risk you can take to try to find these stocks that could go 10 times in a short amount of time. Here's the
blue chips 10 times. I mean, look at like Google and Tesla. You don't have to buy a penny stock to do that.
The thing. Anybody that comes into this and you're watching this video and you're thinking, I want low risk, Mo, but I want 10 times the rewards, this isn't the video for you. Just keep on walking. Go find that unicorn fart and Skittles, because folks, we're not going to have that here. What we have today is going to be some of the stocks out there that have been getting attention.
Another minute of this.
These are the best penny stocks to buy now, in my opinion, because the public are looking at them. All you need is
the public are looking at them? The public's a moron. The public buys penny stocks. That means nothing.
Major run from one of them, and you can see that 10 times movement upward. So I have $0 in these. I have not a penny. But I am watching them. I'm trying to learn. I'm trying to come up with some systems. We will see if we can somehow crack the code to figuring out what are the best penny stocks to buy now.
Even I'm not dumb enough to buy penny stocks, but here, for people even dumber than me, here's 10, even though I don't have any money in them. Who listens to this stuff?
And then finding a system where we can invest a little bit, not all of it, folks. You don't go all in, and figuring it out. If this is
tell that to Jeremy.
Interesting to you, you put the fire emoji down below. You put down where you're from. How about a thumbs up to the family? Let us know where you're at, man. Let's just share some of the information out there. Now, I'm going to share a couple of things as we go through. Make sure you get your...
All right, this is an advertisement. Yeah, every garbage YouTube channel recommends this Momo thing. Get a proper brokerage. Just do like Fidelity, Charles Schwab, or Vanguard, or through your bank or something. Don't bother these trash apps.
Free stocks from Moomoo. 30,600. Wait, I've been watching my portfolio and what I'm...
Blah, blah, blah. Okay.
Selling. Folks, the best penny stocks to buy now. Let's get into it. Why do I like them? What am I watching for? If you're here to look about under the hood and find the financials and the growth and all the orders, this isn't the video for you. But if you're here to look at the penny stocks that have been getting the mentions,
You've already talked about this. So these penny stocks have been getting mentioned, meaning that a lot of morons are talking about them on social media. Therefore, I want views. That's the point of this video.
The public are starting to watch. You're seeing YouTube.
The public's watching. You're seeing YouTubers talk about it. Oh, because YouTubers talking about a stock is always a great sign. Just like when YouTubers talk about FTX and what is it? Established titles. New-Base Therapeutics. So this is a NASDAQ garbage biotech stock. Believe me, I know all about those. I used to be all over this. No revenue, great. Therapies, rare genetic diseases, yeah. So you should already know rare diseases is the hardest field in biotech to get into. In fact, I think Martin Shkreli was in that one as well. You're talking about like an uphill battle, like at least going like immunotherapies or something like that. Rare diseases, guess what? They're rare. Guess what? They don't have a lot of customers. Guess what? You have to charge a bunch of money. Guess what? It's unpopular if you charge $150,000 for your therapy or your product. So for a biotech company like this, it usually doesn't really matter to look at these stats. I mean, it does. You want to get an idea of how they're dealing with their debt, how much money they're bleeding out, how long before they have to raise again. Let's see this dilution, massively diluting, because it's pre-revenue. Your only hope with stocks like these are just hoping for a buyout. Do they have a website? See their pipeline. Everything's preclinical. Do you know how long it takes to go from preclinical in biotech to like even remotely close to a buyout or FDA approval? You're talking like 5 to 10 years. Why bother with a stock like this? We have to wait 5 years and hope that they don't go bankrupt before that. This is trash. I don't even have to go further on it. Preclinical, like preclinical means like, oh, we haven't even actually validated our own products yet. We haven't even validated it in our own internal tests. We don't know if these products work. Waste of time. Let's see. I see here they're competing in Huntington's disease. Guess what? There are gene therapies for Huntington's disease now. You're fighting an uphill battle. In fact, I was invested in one of the companies that had one of the first gene therapies for it. Or maybe that was the other one. But anyway, there are gene therapy candidates for that now. I doubt this is a gene therapy, let's say. It doesn't even say how they're going to deal with it. They probably don't even know. Technology. Oh, this might be a gene therapy company. Okay. In vivo gene editing. Okay, I was mistaken. So it's one of these gene therapy companies. Anyway, not terribly interesting. It's way too far away from anything even happening. This is just a waste of people's time and money.
That list. Now, where does it go from here?
Let's see what he says.
Do these become the best penny stocks to short? Or, how's this play out? Now, we've done this a few times. And as we look at this one, New-Base Therapeutics, I will tell you, most of the times when I look at these penny stocks, and you can come down, what you will notice about the therapeutics, they're not big companies. Look at the market.
$5 million market cap? Forget it. Just leave. Get out.
Market cap on this stock.
If you really like this company's products, wait for whatever company scoops it up in bankruptcy and it ends up in a bigger company. Wait for that to happen if you really like one of these individual candidates. Don't bother with this one though.
5.6
in my opinion. Not financial advice.
2 million. I think
Sorry, I should rephrase. If I were someone looking at this, if I were looking at this stock, I would wait for the products, assuming they're any decent. I haven't looked at these products, so I don't even know. Assuming that their candidates have any potential at all whatsoever, probably would wait for some more a more developed company to scoop them up.
If we get a couple of the boys around, we go down and we drum up a hat and raise the money, we could probably own this company. But that's why it moves so much. So if they have a little bit of positive information coming out from a drug, from anything, this thing starts to run. Check out the last 5 days. Oh, if we would have talked about this right here.
But you didn't. That's the problem with penny stocks.
And up 36%.
Because if we talked about it at this time, it ran up a ton. But in reality, when you own penny stocks like this, here's what it actually means. Is there no chart? Yeah. Oh, another one of these flat lines, dead heartbeats. But for one of these companies, when they spike up, guess what it has to mean? you have to own it well way in advance. Like, you only have a very short window right here. Most people hold these things, and as you hold it, it goes down and down and down and down and down. They say, oh, what if we talked about this before this spike? Like, what do you mean? Like, right here? What if you talked about this spike? Like, or you talked about this company right here before this spike? Oh, surprise, you're down. You lost your money. Waste of time, trash.
And you said, well, I'll buy here. I'll buy at the 36%. That's what I mean. If you're watching them, look where you would have been just a couple of days later. Another 156%.
Yeah, and if you were a month too early, you lost 70%.
Up. So I'm trying to find and keep my eye on these little movers now and seeing if we could throw a few bucks in there and set a couple stop losses and see where we go. But
just play roulette.
This thing at one time
wasting your time.
Down, about 13%. We saw that 14% before it finally blew up.
Yeah, you see right there, it was negative 10%. So if it triggered your negative 10% stop loss, surprise, surprise, you're done. That's why it's pointless to waste time with this volatility garbage.
So what's the stop?
Most people set their stop losses in the 10 to 20% range.
Stop loss. Set it maybe 20% on.
That's what I just said.
Buy 10 penny stocks are rolling up. Short time. Put 20% stop loss. Put about, a little bit of even money on all of them. Wait for a couple of them to hopefully blow up. I don't know.
Yeah, you notice this guy has not looked at a single statistic. We haven't seen the income statement. We haven't seen anything. Well, the chart kind of spiked up then, so if you bought before the spike, you could make money. Oh, brilliant financial analysis. Just buy before the spike.
Let's figure it out. Let's do some back testing. But this one right here.
Back testing? You don't want to do back testing on this one. I already did.
270.
Yeah, when these losers talk about penny stocks, they never expand beyond the 5-day chart. Gee, I wonder why. Why don't they click more? Because people would see it's garbage. That's why. Penny stock trash YouTuber channel push the 1 month to 6 months to 1 year chart challenge impossible. 99% fail this.
207% up. Ticker symbol NBSE. First one I noticed on the list. That is.
He's not going to click it. He's not going to click it. Hey, click the 6 month chart. Click the 1 year chart.
Continues up. But look, when it's only a $5 million company, understand this. It won't take much, just so you can see this, it won't take much for this stock to move up. All right. So the next on the best.
I knew it. I called it. I called it. He would not click that chart.
I'm watching.
Oh, man.
This is honestly
called it.
When I used to buy penny stocks, and I used to do this when I first came on YouTube. But then
all right, he's already on to a new one. Greenland Technology Holdings Corp, GTEC. I knew he wouldn't click that chart. How did I know? This is literally the same investment strategy applied to Dogecoin. Just buy before the spike. Yeah, exactly. Let's see. $48 million market cap. It's on the NASDAQ. $3. Let's look at the big chart here. Oh, it's trash. All it's ever done is lost money for its investors. At least it's profitable, unlike Jeremy's companies. Okay. Revenue drops and grows, kind of flat, not going anywhere. Cost of revenue is declining. They're keeping their selling general and admin costs low. That's good. Positive operating income. Positive net income, but still declining. Barely positive gross margins. This is just mediocrity. I guess he had to balance out that other one. Let's see the what the shareholders are in for. Great, their equity's going up. They're not underwater on their house. Let's see their cash flows. Positive cash flows, but kind of dipping in and out. Very minor. They're only doing $9 million. Financing. Let's see. Do they dilute their shareholders? They do, but not much. Okay, this isn't the worst company ever, but let's see what they do. Transmission products. Oh, it's in China. Forget it. No thank you. Mediocre Chinese company. No thank you. Bye-bye. Bye-bye. Not doing that. Let's see what he says.
Again, everybody out there, you mentioned a penny stock. It's like, oh, he's going to hold it for 27,000 years. No, you're in and out, folks. This is what it's about with penny stocks.
In and out, incurring short-term capital gains. So dumb.
90% of them are going to go to zero. If you don't know that, you shouldn't be dealing with them.
90% are going to zero, so buy stuff that doesn't. Buy like a normal stock, like normal people.
But this is one, When I used to look at it and see these charts like this.
5 days. Yeah, the 5-day chart looks great. Why don't you click the 5-year one? Oh, why do you click the 1-year one? Oh, because all it ever does is lose money for people.
Look at that regression line. Beautiful for the short term. Up 175%. Dropping a little bit in the after hours. Go down.
Whoa, he clicked the 1-month chart, guys. Can you believe it? This is a first for a penny stock channel.
The month. Wow. So right now, I don't know the story behind it, but I can tell you this.
I don't know the story behind it. Then you shouldn't talk about it.
64 million. Very small penny stock. Nothing to write home about. Nothing to get excited. Like I said, we drum up a couple of the folks around. We could probably buy this thing. But there you go. So this is one I do like that graph. If you look at the last.
Just look. Oh, this is interesting. This is worse than I expected. I hadn't seen this video. They don't even talk about what the company does. They just look at the chart and said, look, it went up. And if you bought before it went up, you would have made money. You know, this, as bare minimum as this analysis is, you should talk about these things, at least try to, before they go up. This is just a list of like, look what went up in the last month. That doesn't help anybody, even like if you're a loser in penny stock land.
5 days is just beautiful. So I'll keep an eye on that.
Click the 6-month chart.
So far, that's my #1 pick.
Click the 1-year chart.
Based on charts alone.
You love charts. Why don't you click the 1-year chart? Based on charts alone. Yeah, click the 1-year one.
But as we move forward, you can see this one. This one had the pop, and now you're...
Is he going to do the same thing this whole time? Just like, look, it went up a lot recently. Before it like goes straight back down. Addixtit. Let's see. How do you spell this thing? Get out of the way, Jeremy. ADTX. Okay. No 1-year chart. What is this? Like a brand new company? What's going on here? Oh, all it's ever done is lost money for its investors. Biotech company, probably no revenue. Yeah, no revenue. Oh, they had a little bit of revenue in 2022. Okay. Yeah, they're just doing the binary event lottery on biotech companies. We've already talked about that, like how to deal with these.
Seeing that sell-off. But I wanted to bring it up because it went up 500%, dropping back.
Yeah, geez. Biotech companies go up a lot when they have positive clinical trial results. If you could predict how to, you know, if you could had any idea or any background of that, yeah, sure, maybe you could make some money, but just like skimming around 5-day to 1-month charts is not going to help you get an education on how biotech stocks work. Especially if you don't even do the bare minimum of looking at like what they actually do in biotech. This is totally useless to any viewer.
Down now, $32.95. And this stock right here, look at the market cap on this. 6.72 million. You would
then don't bother.
$30-something a share was huge. It's not. It's not one of them monsters that you would think. What is it? Adatex? Inc. There you go. There's one we're watching for the best penny stocks to buy now to see if these things will roll up. I'm actually making this video for two reasons. One, for you guys to see what I'm thinking, just kind of looking at, putting it together, saying, all right, guys, I'm going to look at these. I'm going to do a little experiment, and we're going to pretend we put a little bit of paper money on this and even amounts, and we're going to come back and see how this thing has done.
We're going to do an experiment. Pretend that we put our money in at the perfect time on a penny stock, which you have no ability to predict whatsoever, nor are you telling people how to predict it. So stupid. Oh, geez, if only I had a PhD in, biology, then I could maybe have an idea of what's going on with these.
Down the road. So subscribe down below, hit the bell.
Okay, I think I didn't realize this is just all... This penny stock is cheap and it went up a lot. Yeah, okay. Seems like a waste of time. Man, these garbage YouTuber stocks. All right, so now this is the one I'm going to be a little bit more gentle on. Again, this is the first time I've seen this guy's channel. I don't know anything about it. There's no proof I've seen so far that he recommends trash or he's a scammer. I scrolled on his channel briefly. Most of the time he's talking with the general market, which is fine. He does, however, have this video called "You've Never Heard of This AI Stock," so I'm curious to see how this turns out. Okay, it looks like it's just a meme intro. We're on TikTok, apparently.
For 70 years, 80 years, 90 years, 100 years, 1,000 years, and next thing you know, you can't retire. You understand what I'm saying? I want you to be able to work the normal 30 years.
Yeah, I can't retire. I tried I retired in my 20s and it was a total failure, so here I am again. So I got bored.
Even if it was 20, even if it was 40, family. And I want you to be able to say, hey, I have investments that are going to carry me through my retirement so I can live the life that I need to live.
Don't tell your friends and family that you have investments. That's the worst mistake you could make.
If not, I got to work a million years and then get up, go blink, and now you back at work again after you fall asleep. Like a revolving door, family. I want better for you. That's why I do what I do. Now, if you down for the mission, if you support that and you want people that financial literacy, go ahead and hit the like, hit the subscribe.
Oh, this is the intro. Okay, I was like, when is he gonna talk about the AI stock? Nice ad.
Let's get
There you go, Kenan. You got your 10 cents from me.
to it. Shout out to my OGs who've been rocking me for a long time. You already know what time it is. I'm gonna bring you some receipts. I'm gonna bring you some facts.
Okay, I see here there's an ad for Moo Moo again. That's not a good sign. I think we'll skip ahead. Let's see. When does he talk about this? Apple. We're not talking about Apple. I guess the company's called Splunk. Is this what he's talking about? Let's see.
I want to also get over here and show you this stock that I'm talking about. And what is it? It's called Splunk. And now this is the play, how I'm looking at it. But these are the technicals on it, right?
Technicals. Oh, that's a good sign. Technicals. Just draw lines, right? If only it were that easy.
I get into what is going on with it and everything like that. But first, I wanted you to see it. And now,
Just draw a line at the random segment at the bottom. Just draw a random line at the top. And then draw another line that shoots straight up. Man, I should get into this. Investing looks easy.
hold up. I said Splunk. Hold up. What? That sounds crazy. And I'm looking at it and I see that it was $68 in the past year. But right now, it's $124.
It went up. Buy stocks that go up. At least it's a little bit better than Jeremy. He buys stocks that go straight down. It's okay. It's a step above Jeremy. I'll give him credit for that. This stock went up, so buy the stock because it went up.
Going on with this company, family? Well,
That's right. Actually, if his stock does go up, you should ask yourself what's going on. It is shocking how many YouTubers, like the last guy we saw, Stock Mode, doesn't even look into why.
you know what? The big dogs is buying it in secret.
It's crazy how little pushback technical analysis gets. You and me both, Atlas. You and me both.
And they ain't telling nobody and they ain't making no noise
Draw a line at the bottom, draw a line at the top, and then draw a line straight going up. I've done technical analysis.
about it. So at a minimum, I'm going to put this one on my watch list and see how I can make money on the way up with it or on the
Yeah, we need to talk about this. Putting stocks in your watch list, what a total waste of time. Just like buy an ETF. Buy an ETF and then spend this time you do obsessing about the narratives around stocks and like get a certification or like get an easy degree or something. That's a way better use of your time. Like even for somebody like me, I love investing, but like again, like 80% of my net worth came from the fact that I have 500 million views on YouTube. Most of it did not come from investing in stocks.
way down with it. Now, how do I know the big dogs is buying? When you look at the NASDAQ, you can see that it's owned 87.71% of this company. Almost all of it is owned by the institutions. Family, they loaded the boat last quarter and they're making a lot of money here. And they're the ones who are pushing it up and they're trying to make it not lose. But
What?
because they see it as a cash flowing beast. Imagine you
If you want to see it, if a company is a cash flowing beast, you look at the cash flows. You don't look at the institutional ownership. What is he talking about? All right, so I guess what he's saying is that it has 87% institutional ownership. So that means that like the suits on the inside know that this is a great company. It's going to go up. Where to begin with that? So first of all, this is 2023, not 2008. In case you missed it, BlackRock and Vanguard own like literally every single stock on the stock market. They got handed trillions of dollars during the Corona bailouts and stimulus and bought up literally everything. But all right, so let's see. So I have here prepared, let's see, Yahoo Finance. So let's go to Splunk. Let's see if he's telling the truth, first of all. Yeah, they do have 88% or almost 89% held by institutions. As I said right here, it's Vanguard, BlackRock, and a whole bunch of other like Vanguard mutual funds and everything else, right? Makes sense. Here's the problem. Let's just go here to a company like Corsair Gaming. They have 78% held by institutions. Having a high institutional ownership rate means nothing. Like literally every company other than like total trash, like penny stocks, like StockMo is pushing. Everybody on the stock market has like 50 to 80% institutional ownership. That doesn't really indicate anything. It would only indicate something if it blew up. It went from like near 0% institutional ownership, which is impossible now. If it went from very low institutional ownership to high institutional ownership, that may mean something, but it means less now because, as I was saying before, most of these large holding companies, like for example, Spider, Fidelity, Vanguard, BlackRock, they have to own these companies in their ETFs and their mutual funds. That isn't necessarily an endorsement. This is another myth that I see thrown around a lot. It's high institutional ownership because it's included in passive ETFs that are managed by Vanguard and BlackRock. Thank you, Atlas. That's the exact point I'm making. And you can make this point for any company. So again, we have Corsair Gaming, 77%. Let's go to Stag Industrial. That's like, a mega cap, blue chip. It's held 90% by investors. Does that mean Stag Industrial is the secret company that's going to blow up because the insiders, the suits know? No. So if a company has 9% institutional investors, that doesn't really mean anything. At least it doesn't mean the point he's making. Yeah, unfortunately, this is kind of appealing to the conspiracy mindset. Like, the smart people know, you got to follow them, which it just doesn't bear out when you look at the actual information.
You had a rental property, and it was just bringing in tons and tons of cash, family, that you could actually spend on things. That's
the GME and AMC frenzy has absolutely ruined the minds of retail. They're all convinced anything bad that happens was because of the hedge funds and the suits. I totally agree. And again, if you want to find out if something is a cash flowing machine, look at the cash flow. Don't look at the institutional ownership, which I've already demonstrated doesn't mean anything.
That's what they're thinking and looking at with this company. Now, we're going to get into the fundamentals of the company and everything.
You should have done that first. Look at the fundamentals first, not like rumor monger about the suits.
Just like that. But first, let's get to the technicals for my people who want to see that. Now,
technicals? I don't want to see that.
Let's take a look. Right now, 124. If it goes above 125, and look at this, woo, we above 125, and we start to hang out above this line, I'm looking to play it to about 140. You understand what I'm?
Why? There's absolutely no basis. You just drew a line like, if it goes up, it's going to go up. There's no basis or reasoning behind this. And even by technical analysis standards, this is pretty lazy. This looks like it's like a Robinhood screenshot or something similar, and he drew lines in like Apple Paint or whatever it is. Like, credit where it's due, even though they deserve no credit at all. Actual technical analysis platforms have all kinds of statistics and metrics, right? This is just Apple Paint. He's not even using the again, I think technical analysis is total garbage, but even within that world, he's not using the proper tools and techniques for it.
I'm saying, but I would use,
like, you can't use a cropped screenshot. This isn't even the full chart. He crops it at the bottom. There's like black bars. You can't use a cropped screenshot from the past week. So it's a 1 week chart. You can't even really properly do technical analysis on that. This is just fundamentally flawed.
What they call a stop loss. I'll put my.
You know what's great? You don't have to worry about stop losses when you're just a passive ETF investor. You don't have to waste time on this. All this time you could think about strategizing, drawing lines, and doing stop losses. You could get like a certification or another degree, or like focus on getting a promotion, or starting a YouTube channel, or anything really other than this.
Stop loss at about 119. This means that if I got in, let's call it 124 or even 125, I'm looking to say,
Here's another advantage of like passive ETF investing where you can focus on your life and job. You don't have to worry about getting in. You don't have to worry about the timing.
If this thing falls at about 119, I'm cutting out of it.
Even with all this said, though, it's looking bad, but it's still not as bad as StockMo and Jeremy.
And then I look to buy it closer to 100 to ride the wave.
Let me just look again. I'm pretty sure he is talking about a company that's not like a negative knife like Jeremy. Let's say. I'm committing blasphemy in penny stock land. I'm clicking the 1 year chart. Assuming it loads. Yeah, well, it's flat. This isn't the best thing ever. Isn't this like an AI company? Cloud services. Yeah, isn't like they have hype behind them and this is the best they can do? Doesn't look amazing if we're just going to look at the charts.
Right to the promised land. That's what I would be looking to do. But I would use a stop loss that
promised land, to the moon. You have to throw these terms out of your vocabulary.
Proper risk management. Now,
proper risk management. Let's see what he says about that. This will be interesting to see.
The support level is about 122. And if it breaks under 122, then I'm going to switch my mindset and say, I'm going to get stopped out at about 119, which I might change my stop loss because you got to be.
Yeah, this is technical analysis. If it goes down, then I'm going to think it goes down. And then if it goes up, I'm going to think it goes up.
Be really proactive with things like this and say, I'm trying to play this down now to about.
So if it goes up, I think it's going to go up and I'm going to play it going up. And if it goes down, it's going to go down and I'm going to play it's going down. Here's the problem. Look at this up, down, up, down, up, down, up, down, up, down. There's no way you could predict any of this.
110 because you can make money with what's called a put option on the way.
Automatic disqualification. Don't bother with puts. You have to get the price and the timing and the amount of movement correct. If you're at the point of drawing random lines in Apple Paint, you are not sophisticated enough to do that. I tried puts. I did puts on a biotech stock, and I got the movement timing right, but I didn't get the price right, so I still didn't make money on it. That's how difficult it is to work with options. Don't bother.
Way down on the stock.
Like you said, it's lazy TA. It's not even selling the snake oil well. 100% agree, Atlas.
But this thing has been pumping up like crazy, and institutions are the ones who are making a lot of money with it. So we want to think.
This thing has been pumping up like crazy, and it's institutions who've been making a lot of money from this. There's absolutely no evidence at all whatsoever that's happening. As far as I could tell when I looked at their holders, they're mainly holding it, other than like 9%, 7% here, they're mainly holding it in these funds, and they can't just trade in and out of it like that. The evidence does not bear out that conclusion. And yeah, like let's see, the past 5 years flat. I mean, I guess he's probably talking more recently, if I had to guess. If I were to look around, it probably correlates with all the other tech companies and AI stocks. But again, like there's nothing like really dramatic or exciting about this performance. 30% in a year, you could get that again on the S&P 500. This reminds me of the evergreen crypto narrative about institutional investment. So I don't follow that stuff. It's interesting though that they say the same thing. If I had to guess, everybody who has this mindset and approach to investing all does the same thing, where they rumor monger and fear monger and conspiracy monger about institutions, the suits. Yeah, because institutions and the suits are always looking everywhere at all your trash YouTuber stocks, right? They're always on the verge of seeing your genius. You're going to get to the moon. Just wait. Get a job. Like actually stop being a moron and just work hard and save.
What can we do here, and how can this make any sense? Before we get to that, we want to look at the fundamentals.
I worked hard. I spent every single day in my bedroom churning away, like making YouTube videos in like a little hot office dungeon, and built up my portfolio from nothing. Work hard. Don't do this like, I deserve to be rich because I'm a 20-year-old young guy and I'm so special, I'm so amazing. Get that mindset out of your head. It's not going to happen unless you actually earn it, not like drawing random lines on stocks and thinking you're a genius just because you exist.
Fundamentals of the company mean this. Is this company making money? Do they have a good business model or not? Right? That's what you want to think about with the fundamentals.
Yes, you should have thought about that before you drew random lines or just like looked at a random institutional, an out of context institutional ownership percentage. It is an indictment that it's taken him 6 minutes to even look at a single statistic.
Fundamentals of the company. At the end of the day, why do businesses exist? To make money. So let's look at it. Now, price to sales. This is how you look.
If you want to look at if a business makes money, you don't look at the price to sales. Price to sales only means how much you're paying on the share in the stock market relative to their revenue and sales. It doesn't it's not like a direct indicator of whether the company is profitable or cash flow positive. That's not the right term to be using. Very weird.
Look at a company and compare it to their industry. Sales just
compare it to their industry.
Means revenue. What are they bringing in, right? What money are they?
Right. So bringing in revenue, as we saw before with the other companies, is not a guarantee you're actually going to keep any of that revenue. Plenty of companies spend all of their revenues on the cost of revenue or selling general admin, which I showed you on Jeremy's picks. And especially if you want to look at the revenue or the cash flows, look at the revenue and cash flows. Don't look at the price to sales. Again, that's for determining how much you're paying. Are you getting a good deal of what the company actually does? It doesn't determine if the company itself is actually profitable.
They bring it in. Now, when you look at their peers, and I'm gonna simplify.
I guess he has one of these these like young guy investing stock market apps, and he just clicks around on the stats. Like, well, this kind of has a interesting looking graph, but it's not relevant to what we're talking about.
I'm gonna oversimplify it, but I want to again do this so even a
I don't think you could simplify it anymore.
5-year-old can understand it. You want to say, hey, look, I want to pay the lowest amount for a company, right? So
Yeah.
when you're looking for a price to sales, you ask yourself, is 8 more? That's the industry. Or them, 5. Which one is more? The 8 is more. I don't want to pay more. I want to pay less. So this company, SPLK, even though their name is crazy, oh, they cost less than the industry that they're in. That's good.
All right, pop quiz. Why is what he's saying wrong? Pop quiz. Answer. If you can't answer, you got a problem. You got to study more. Why is what he's saying wrong? Tell me. I hope you know. Oh my goodness, I hope you do. It'll be embarrassing if you don't. Oh man. Oh man. I hope you guys get this. Why is what he's saying wrong? The price to sales on this company is lower than the other ones in the industry. That means you're getting a good price. Why is that? It could be right, but why is it possible that's wrong? Uh-oh, you guys aren't figuring it out. Uh-oh. Uh-oh. I think you guys have been watching too many finance YouTubers. Uh-oh. Uh-oh. You got 10 seconds. That means their value isn't keeping up to the industry, most likely. I'll wait. I'll wait on that one. I'll wait for one more answer. Interesting. Interesting answer. Play the clip one more time so you guys get a chance to understand it. It's a single metric with no context. You can say that about any point in this entire video. It's a single metric with no context. I'm stealing that phrase. That's funny. Listen one more time, guys. It's a single metric with no context.
For a company, right? So when you're looking for a price to sales, you ask yourself, is 8 more? That's the industry. Or them, 5. Which one is more? The 8 is more. I don't want to pay more. I want to pay less. So this company, SPLK, even though their name is crazy, oh, they cost less than the industry that they're in. That's good.
Okay. All right. So people's answers were, it means their value isn't keeping up to the industry. It's a single metric with no context. It's an overvalued company. Less overvalued compared to their overvalued company equals profit. All those answers are right in different ways. The answer I was going to give that it's possible if a stock is cheap relative to its peers, it's cheap for a reason. And that reason is maybe it's not doing a great job. Maybe it's cheaper because you're getting less for your money, right? So there are a whole bunch of different examples. People are willing to pay more. This is why you see high PE ratios, high PS ratios all the time. People are willing to pay more for value, and they're willing to pay less for things that aren't as good. So sometimes like a really low price to sales ratio, that can happen in all kinds of different circumstances, right? So this gets back to what Atlas is saying. That's a single metric with no context. You know what has a really low price to sales ratio? A company that just had a massive failure and their stock price plummeted down to nothing. That's a really low ratio. But it also means that their company is blown up. Like, so for example, I know biotech companies where they have some products, so they're earning some revenue, and then one of their clinical trials fails, and so all the value they had from the assumed success of that clinical trial collapses overnight. And so what that means is their price to sales plummets down to really low. So it looks like it's a good deal, even though their main product just blew up and failed and they don't have any replacements in the pipeline. So a low price to sales, especially if it's really low, can actually be a very bad sign. It doesn't mean you're getting a good price or you're somehow winning against the suits. I'm not saying it's necessarily the case with this company, but he hasn't said why it would mean that necessarily either. So that's a huge problem. That's a huge red flag talking like that. Yeah, that's what I mean by no context. Yep. Yeah, you got it. Your answer is probably the closest, Atlas. So again, like a low price to sales ratio, depending on how low it goes, is actually a bad sign.
That's good. So you know what? But that's
No, it's not.
sales, right? That's the sales. That's the revenue they bring in. You don't get to keep all of your revenue. You got to spend it on the operation of the business.
That's true. What he's saying at that part is accurate.
The earnings. Oh, hold up. They're losing money.
Who called it? Who called it?
That's not good. The industry that they're in is actually making money. The PE,
Oh, maybe that's why their price to sales is lower.
the industry they're in is a little high. You want it to be like 25 or even 20, but it's at 36. So that's even high. The industry is overvalued. However, they're not even making any money at all. So I don't see this one yet as a
What knocks people out is the risk of ruin.
Yeah, so why would you buy a company in an industry that is booming and has all the wind behind their sails and they still can't figure out how to make money? Again, if you want to profit off of AI, ChatGPT, the future, as Strongman Personal Finance would say, just like buy Google then. Don't bother with this trash.
term hold. I see it as a swing trade.
Swing trade? Swing trade? If it's a swing trade, then don't bother looking at the fundamentals at all. This is stupid.
Get up and get out of the trade. Make money here. If it drops, make money.
Wait. Get out on the trade. But you yourself said the most you can expect it to do is break out a few dollars from where it is right now. So you haven't even established, I don't believe in swing trading or like, get in, get out or anything. Putting that aside, that I don't even believe in that. You yourself have not even established any precedent to expect a massive run up for any reason whatsoever. So I don't know how that could be the conclusion or the recommended strategy from that.
On the way down. If it is on the bottom, pick it up, ride it up to the top.
This is like, again, we've been 8 minutes through this garbage. Would you rather blow 8 minutes of your life or just buy an ETF and get on with it and like be with friends and family or like improve your skills and get more money at your job? This is ridiculous.
Boom, make money like that. But it has the potential to graduate to a long-term hold. And that's why I say at a minimum, put this one on your watch list and I'll show you the ticker again.
It has the potential to graduate to a long-term hold, even though, despite the fact you said it's in an industry that knows how to make money and is booming, and this is like one of the few companies that hasn't figured out how to do that.
And it's right
We still haven't looked at any financial statements whatsoever.
here at the top, SPLK, aka
These are like basic like app, like those little random statistics they throw on your investing app.
Splunk. And have you ever heard of, now I want to say you want a rabbit hole now, but if you
Now, I'm not saying this is necessarily a garbage stock because I haven't looked at it yet, so I'm not saying he's recommending one, but I don't agree with his strategies.
look up spelunking, right? I think I'm saying it right. That's when you go underwater cave diving. Family, people are diving underwater in caves. And this company got their name kind of inspired by that, which is insane to me that people will go and squeeze through little caves
He's really fixated on the name. The name doesn't really matter.
underwater with an
I guess you have to be entertaining on YouTube.
oxygen tank on their back. Yo, come on, man. Yo, hold on.
Come on now, dog. Come on, man.
That's insanity. And there's a lot of spooky, scary stories on YouTube even about that if you wanted to go down that rabbit hole. Now, but what does this company even do? Is it
Should have asked this in the first place. A little late for that.
about spelunking? Is it about doing anything like that? Actually, it has nothing to do with that, right? So hold up with that name.
Stop the cap.
Name is Cap. So Splunk develops a machine learning platform used by some of the largest companies like Heineken, for example, right? Which makes beer and things like that, right? Alcoholic beverages and non-alcoholic beverages. And it says it helps businesses make real-time decisions, right? So, oh, that's good. They are in, wait, machine learning. I heard about that. Isn't that artificial intelligence? Oh,
This is like really nitpicky and this is not my field, but yeah, this is not my field. I'm just not going to comment on that, but I think people who know what they're talking about will know what's going on here.
is pumping up because the artificial intelligence space, but the big dogs aren't making any noise about it. So we got to keep an eye on it on a minimum. Now, it says they are addressing a piece of the addressable market that they are in worth $100 billion, but they're only
A business is trying to capture market share? No way! I've never heard of that. Whoa, a business knows the total market share that they're operating in and they want to capture a percentage? No way! Buy ETFs, please, 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 if you're watching this channel, just buy ETFs and stop this.
accessing less than 3.8 billion.
Okay, is he ever going to look at a financial statement here? See here, there's a article about it, but he's not actually looking directly at the statistics and context. Let's see.
Oh, right.
Let's see what he says.
Put in a lot of recognition from management that they're focusing on profitability.
I commented on a few of your videos about 2 years ago using the username skills who kills. I think I remember that. I'll have to look. I'll look after this. I finally got around to ditching that awful username, and it's good to see you again. Oh, I'm so happy I had somebody come back after 2 years. I really like my commenters. I wish they would stick around more. But yeah, good to see you, Atlas, aka Skills Who Kills. 2 years sticking with the channel. I appreciate it.
Ooh, so they're not even profitable yet, but they're focusing on profitability. Okay, yeah, anybody.
Every company is focusing on profitability. Jeremy's honest and Fubo and everything else is focusing on profitability. That doesn't mean anything.
They can focus on that, right? But do they have any money? It says this: as of Q2, for the trailing 12-month free cash flow was $804 million, which is up 273% year over year. So they're getting a cash flow, right? Oh, that does.
Cash flow, though, can include money you're getting from taking on debt and diluting your shareholders into oblivion. I'm not saying that's happening, but again, out of context, that statistic isn't very helpful.
Sound like it makes sense. As you getting your cash flow, right, to becoming more profitable. Now, again, I don't want you, and let's hold up. I do not want you to run out here and just buy it blindly.
Okay, that's good. That's actually good advice.
On your watch list so that we can see it as this thing evolves over time.
Put it on your watch list, but also wait for this line to get broken either up or down. And if it breaks it up, that means it's going up. And if it breaks it down, that's going down. It's kind of conflicting messaging.
To see if it makes sense to one day graduate into a long-term hold. For now, I see it as a trade. That means I don't plan on holding this one forever, but I do see a lot of the big dogs trying to pump it.
Yeah, I guess when you're a YouTuber talking about stocks, you can't lose, right? Because if it's at all risky, just say, look at it, and then you get credit if it goes up later. Because you said, oh, look, I said it, look at it, and it went up. Or you get credit if it looks a little risky, you can say, just trade it. What does that mean? You're absolving yourself of like all connection to the outcome of it. Like, I just said just to trade it. So, you know, if you're trading it right, you can make money when it goes down. So you're a winner in all circumstances. You're a winner if you say just watch it and it doesn't go up. You say, look, I just said just watch it. You're a winner if it goes up because you said, oh, look, I said watch it and it went up. You're a winner if it goes flat because then you said, oh, look, I said just trade it. So I guess you can succeed as a finance YouTuber if you say literally every single possible strategy at the same time and take credit for all of them. Put it on your watch list, but also trade it. Let's pretend that they're right and high institutional ownership isn't meaningful. Is there any evidence that the institutions outperform the indices anyway? No, they don't. Good point. Very good point, Atlas. Very good point. Thank you.
So now, let's take a look at this. Their PE. It doesn't
I can tell this is part of a larger page with statistics. Why not look at the other ones too?
exist. The price of their shares and the price of their company versus their earnings, they're making a loss. In a recession, in a bad economy, companies that are making losses get smoked. Look at all of the meme stocks. Look at all of the crypto.
That is true, actually.
Things that weren't generating like
This part is true.
profit, they getting smoked. But after they get smoked, that's when we want to pick them up, and it makes sense. But then I look at
Not necessarily. If a stock goes massively down, that doesn't mean it's a good buy. Again, if like the fundamental underlying problems of the company are still there, whether the stock is, you know, at $10 or $1, it's still a trash stock.
the forward PE,
You're just getting a better price on that trash stock.
which is when class was in session in the last video, I told you about the forward PE. This is the earnings that
Like, so for example, if you have a Jeremy stock chart where it just like goes down like this forever, there's no possible entry point where you can get ahead and make money on it. It's literally almost mathematically impossible to make money on a stock that does that.
they kind of expect to impact the price of their company. So they expect to be profitable.
Okay, we're only like a minute or two away from his last minute ad reads at the end of the video, and I still haven't seen any of the income statements or cash flows, so not looking good.
A PE of about 32. Whereas the S&P is like, let's call it 25, if not 29. So they expect it to be close price to earnings to the PE of the SPY. That's interesting. Let's see if they can actually uphold that. So we keep it on our watch list at a minimum and swing trade it if you know what you're doing. So now,
If you know what you're doing, who knows what they're doing with swing trading? Like, again, like I made a YouTube short about this. Most people who get multi-million-dollar net worths, it's from the same three things over and over. It's investing, real estate, or entrepreneurship. It's not swing trading. You don't see anybody who swing trades making it to a whole bunch of money. There are people who make a lot of money talking about swing trading who make money, but swing trading is not a proven method to actually producing high net worth individuals or millionaires. It just doesn't happen.
I told you before.
And so you can say something like swing trade this if you know what you're doing. Well, then you can take credit. I said, only do it if you know what you're doing. Only swing trade if you're going to succeed. Oh, if only it were that easy. Only do this if you're going to succeed. Well, that's not how it works in real life when you don't know what's going to happen and you're not like a delusional 20-something-year-old and you think you're a genius and you know how to do everything when you know nothing.
87% of it is basically owned by institutions, so I'm looking at it like that. But let's look at the price targets on it. They said this on the low. Analysts from Wall Street, right? The big dogs, I'm on Wall Street. No, calm down, Wall Street. The retail investors are the ones taking over now. Like,
no, they're not. Have you seen AMC recently? No, they're not.
good or not. But let's talk.
Retail investors are getting scammed and annihilated more than ever because of these trash apps and these garbage YouTubers. The opposite is true.
About it. They said at 105 is where they see it being worth on the minimum in a bad economy. They're saying 128 is about a fair price. So we kind of slightly under fair price in terms of projections, right? You know, they not your girl, Nancy P. They can't tell the future. So 150 in a nice bull market where AI is pumping.
Wow, it's so easy when you have plus or minus 30% margin of error in your predictions. Oh, so difficult. It's either going to go up 30% or down 30%.
But again, don't expect it to be able to hold those crazy high numbers if it is a swing trade and if they can't hit the targets that they're talking about. But you got to make sure that you understand it. And I'm here to put this on your radar, baby. Now.
Okay, this looks like it's ads. Wow, so again, he's not the worst I've ever seen, but you managed to talk about a stock for, we'll ignore the ads, 10 minutes and not once look at any relevant statistics. So we're going to do that right now. AI, it's the future. Losing money massively. Losses increased 2019, 2021. Kind of mediocre chart. Let's see the financials here. This will be the last company before I do questions and head out for tonight. 2-hour live stream, really good. Revenue growing. Good. Cost of revenue growing. They're only spending, let's see here. 826, 3843. Only 21%. That's not terrible. I've seen better though. Selling, selling general and admin. What are they doing? Oh man, that's why you have a negative operating margin. Let's do that. I messed that up. What are you doing? 3843, 54%. Well, welcome to Fubo and Honest. Yeah, they're growing this pretty fast too. I think they managed to freeze it the last year. That's not too bad. Hopefully their revenues could grow beyond that. A lot on R&D. Oh my goodness. But it makes sense. Like, if anything, these two figures should be flipped. Though I do get it, like in these tech companies, you do need to attract talent and actually pay people decently, unlike in other industries. So I get that. Good. They're cutting down their debt. How much they're spending on it. Net income is, that's going to be hard to recover from, like a $1.4 billion loss. That's going to have long-term consequences. This thing is consistently negative. Dilution. Okay, this isn't, it dilutes, but not as bad as Jeremy trash. That's good. Cash flow margin. Okay, they're improving it. Actually, let me see. Are they underwater? Okay, well, here's the problem. Like in 2020, after they had that massive failure, 2021, they brought their stock underwater. Again, this is like buying a house that's underwater. You buy this, the debts are more than assets. Thankfully, it's only $39 million. It was 110, but if you buy this, you're buying a house that's underwater. Not by much. Positive operating cash flows, that's good. Only recently it was negative. I'd have to see. They probably landed a huge contract or something. Yeah, they're probably really reliant on their few like large customers like Heineken, or was it Heinz? I forget which one it was. Financing is negative. That's good. Investing. Okay, so actually it looks like they are mostly running their company based on their operating cash flows, which is good. This is not terrible. It would have benefited his viewers if he did look at something like this, though. Let's see. Cash equivalents. Current assets 374. Current liabilities 27. Debt's creeping up. Let's see long term. If I had to guess, they probably have a lot of long term debt. Yeah, here's the problem. They have way more long term liabilities than long term assets. If I had to guess, their long term debt is probably even more than their short term cash and long term cash put together. So that means either they're going to have to refinance it, interest rates are going up, or they're going to have to dilute. So that's a big problem on the horizon. their revenue is not growing at, like, this is not commiserate with like tech industry growth rates. They'll have to really scale things up to escape that debt bomb that's coming up in the future. You'd have to actually dive down deep into their filings to see like when this debt is supposed to come up due, because then you could expect a major dilution or refinancing or something happening. Then that would have been beneficial for him to tell his YouTube viewers about. But just put it on the watch list, but also trade it if you know what you're doing. So I guess he's not really, he just doesn't have to worry about stuff like that, right? To be fair, there isn't much difference between this guy and some shills they let on CNBC. That's true. YouTube is the new CNBC. So that's Spelunk. I'm not really blown away or too excited by this company. I probably wouldn't buy it just based on how much they're spending for operations. Though it is improving. Yeah, I don't know. There are better AI companies out there. This just like reeks of mediocrity, which is why it's on the NASDAQ. But you guys are obviously free to talk about think what you please about it. Just looking at this, even looking at the financials, there's nothing in here that makes me want to come back to this and see how they're doing later. I wouldn't even put this on my watch list, to be honest. Doesn't look that exciting. Yeah, again, this isn't an industry where like all the wind is behind their sails and they're flat over 5 years. Pass. Again, like this, if they're struggling to grow this much in an industry where like they're getting handed opportunities and money, imagine if this management team were in an industry that doesn't do a good job. Or sorry, imagine this management team were in an industry where it's difficult to succeed and you have to fight for your market share. Like at least in like AI and machine learning, the market share is expanding out. You just have to like grab it. So you're saying he didn't convince you with all that analysis? No, he didn't convince me. Sorry, the Apple Paint screenshots and Robinhood random statistics failed to convince Eugene Chargrain. That's right. He didn't sell me on the stock. Oh man, that's funny. All right, we'll do Q&A here for a few minutes, and then I will close out the stream. I really appreciate everybody who came out here. Really exciting, really fun. Another 1 minute break. It is hot. I'm gonna run my fan. Back. I was just hovering over my fan there. So we have one question here. We got to get a portfolio update. Well, here's the thing. You guys, I will live stream more regularly, and I'll do paid sponsored video topics. Let me move this out of my way. So looks like I'm looking at the chat. There we go. So I will I'll do more videos, so hopefully I can get more on that. Unfortunately, I took all my money out of the stock market. It's tied up in like a super long-term investment that I'm not going to get back for a long time. And also I bought a house. So I actually don't have a portfolio to show, but I had to get as I said before, I had to get my grubby hands on it. And I took that portfolio and I spent it. So I'll build that back up, and then we'll start doing portfolio updates. Okay. Appreciate the interest in it. It's going to be boring. It's going to be like VT and bonds, but I'll do that later. Keep watching the channels, guys. It's not dead. I'm going to come back after 4 months. Keep watching it, and then we'll get portfolio updates and pay for sponsored video topics. No portfolio update, sorry. Got a really weird long-term investment. Thank you, EC. I really appreciate that. Yeah, you know, it's funny. My net worth is like well past $1 million, but I'm pretty tight right now. I don't have stuff in investments, which is funny. Really funny. Funny how that works out. Nice of you to say, though, you see. But, you know, hopefully in a year or two I'll get access to all that stuff. If I wanted to, I could take out... I paid for my house in cash. So if I wanted to, I could take out a mortgage on it and then access that money, but I don't feel like doing that. Probably not a good idea. My house actually went up in price. Maybe I should just screen record. Yeah, that's better. My house went up in price about as much as I would pay on interest on the loan, but it's still not worth doing it. I just don't need the money, so there's no point. I could have bought a house sooner, but I was like living like a laptop lifestyle, run around the world, have fun. Now I'm settling down, so I bought a house. The laptop lifestyle. Will you guys forgive me if I turn on my fan? Let's see. Hopefully the mic doesn't pick it up. My fiance bought it for me. Really enjoyed watching. Seems like you invest for long term. Do you swing and day trade as well? I invest only long term, and I try to minimize the amount of time I spend doing investment stuff. So I exclusively do ETFs. I used to do individual stocks, and I had some success, but I didn't beat the market, so I stopped. And I definitely never swing trade or day trade. That's a loser's fool's errand. Like, so for example, if you go on a Reddit like Fatfire, the people on there, if you look at the statistics, I have videos about this on my channel and on Telegram. I posted about it. They made their money through investing, not like swing trading, like actual investing, entrepreneurship, and real estate. Those are the three ways they made money. Swing trading, day trading does not produce people who are wealthy and successful. It's a fool's errand. Trust me on that one. I can explain it a different time. But yeah, I exclusively do long-term investing. Trying to minimize times. I like buy and forget ETFs so I can focus on running my business and also getting more skills. I went back to school for accounting, so I'm still running my company, my YouTube company. I am studying accounting at the post-bachelor's level. And also, I'm settling down with my fiance. We're probably hoping to start a family here soon. So that's what I'm up to. And so as I can imagine, like watching these YouTube videos where people draw random lines is like a total waste of time. I don't know how old you are, but if you're in your 20s, when you get older, you'll realize how much of a waste of time that is, and you'll wish you developed skills and I like actually worked hard to make money, rather than like, you know, being, I'm 20 years old, I'm brilliant, my time will come, I've got hustle, I'm gonna be a millionaire, just watch, and falling for scammers. If you're a new investor, I'm sorry, you are a sheep in the middle of a dark forest packed with wolves. Everybody is out there trying to scam you and take advantage of you. Be careful. Especially the people who act the kindest and have the most, you know, upbeat, happy personality. Though that's especially scam coming. You know who I'm talking about when I say that. Nope, late bloomer, mid 40s. Oh, that's more dangerous. So I started investing when I was really young, like as in probably like early university time, like 19 years old. And oh, I fell for so many of these losers and trash and scammers. But thankfully back then I only had like $100, $1,000. So I didn't lose that much. It was a very inexpensive lesson to learn. When you're in your 40s and you decided to start investing, you're finally ready. Usually because people have got a good career going, they've got a job going, and that means they have money to lose. So their mistakes cost more. When you're 40, you think, okay, I'll throw $10,000 in the stock, and you follow people like the morons I showed on this stream today. You'll lose $10,000 instead of $1,000. So when you're a late bloomer, when you're in your 40s, you have to be extra careful than if you're like a naive 20-year-old, because you can learn the lesson relatively inexpensively, like I did for like $1,000 in time wasted. It is so much worse when you're 40s and you have more money to lose. So be careful, okay? I'm glad I caught you at the early part of your investing journey. That is lucky. Yeah, so what I do is I have the stream before this when I talked about it. When I get investing again, what I do is VT and BND, do like a 90-10 split, and then save my time and focus on other things, increasing my income. That's what I do. I'm glad I worked a trash job early and realized that stock stuff was not the lottery ticket people said it was. I made some bad decisions early, but luckily most of my stuff is now passive. You and I are in the same boat. Good job. It seems like we had the same story, EC. Good job. Yeah, I have a very similar experience. Very interesting. Yeah, it seems like I'm attracting that kind of audience now, which is interesting because before I was talking a lot about individual stocks. I will say, thankfully, when I was like one of these like buy individual stocks morons, it was luck, but a lot of them did seem to work out, which is good. I wasn't recommending trash like Jeremy Financial Education, but even still, you probably shouldn't be doing that. I had some good wins on this channel, though. Yeah, so anyway, good ETFs are like VTI, VT, VOO, that sort of thing. And also, it really depends where you are in your journey, too. When people are older, they like more like, what's the word, like dividend income. When you're younger, it might make more sense to focus on growth. It depends. There are all kinds of videos you can watch about that. I actually don't like to put, I know you guys are going to think I'm crazy. I don't like to put money in my long-term investment accounts because I'm really entrepreneurial. So I start new projects and businesses all the time, and I like to grab all my money and take it and spend it on stuff I like, which is also why I have no investment portfolio right now. But if I did that, it would have been harder to buy this nice house, so. You know, it comes and goes. I know people recommend invest, but I don't. Or I know people recommend, what's the word? Doing like long-term 401ks and stuff like that, but I don't do that. Does that disqualify me? Probably, but again, I need to access all my money to do entrepreneurial stuff. Also, too, I haven't worked at like any corporate jobs, so I've never had like a matching contribution for any of that stuff. Keep it all untaxable and withdraw it when I need it. I think my mic is picking up my fan. I'll watch the replay afterwards. I like single country ETFs. Yeah, those are interesting. I would probably just do a general world one, though. Or if you're going to focus on a single one, probably makes sense to focus on the US. I do wish I had more of that hustle energy. It's something I'm working on aside from the hands-off investing. Yeah, at least with hands-off investing, all you have to do is click a button, and then that's it. For like developing or having an entrepreneurial mindset, I was pretty much born with it, so I don't know how you could really teach it. I know there are people who go to conferences and like they listen to motivational speakers and think that's how you do it. I don't know. I'm not really someone to give advice on this because it just comes naturally. So I don't know how to tell someone who it doesn't come naturally to do that. I've done all kinds of projects. I tried starting a social media company like in the 2010s. Obviously, I've made tons of YouTube channels. I have 500 million views. I've done, what's the word? I've gone into apparel, as in like reselling apparel. I have so many projects, I've forgotten half of them. Most of them are failures, but when you're doing entrepreneurship, all you need to do is have one succeed, because nobody really cares about your failures. Nobody's focusing on you. But then when one succeed, it makes up for all the failures, you know? Very happy I haven't had to work a job. Definitely blessed in that regard. How do you feel about CDs? I like CDs, actually. I have a CD. I got a CD a few months ago. It pays 4.75%. It's up for renewal in April, and I probably will roll it over. CDs, though, they have a role. Like, so for example, if you need cash but not immediately, it makes sense to lock them up for a year. Let's say you're waiting to buy a house. But other than that, they do tend to obviously underperform stocks. Other than if stocks are getting crushed, which they're not right now. CDs are good, though. I like the rates. Definitely going to roll mine over to a 5% or 5.5% one. You can get CDs on your investing brokerages, but also you can get them through your banks too. Been looking at PKW. It's an ETF that tracks an index comprised of companies that bought back at least 5% of their shares the last calendar year. Oh yeah, that's interesting. Yeah, stock buyback ETF. That's interesting. I think I talked about a very similar ETF on my Telegram the other month. It's interesting. As far as like novelty ETF goes, it's not the worst. Though that said, I really think like broad ETFs like S&P 500 or the world or total stock market make the most sense, but that's definitely not the worst ETF I've ever seen. Most of our cash is in a money market fund right now. Okay, I know exactly what you're doing, where you are. Yeah, I totally understand that. All right, everybody, it's been about 2.5 hours. Ran out my voice. It's boiling hot. I will be streaming again soon. I hope to see you guys. Seems like this might be the beginnings of a regular crowd. As I mentioned before, follow the Telegram Journal. I have really advanced, in-depth investing and financial analysis on there. Not analysis, but like commentary. And I will be releasing a paid video topic service very soon. So see you then. I really appreciate everybody coming out. This one was fun. This might be the funniest stream I've had yet. Bye, everybody.